Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
A lot of conversations we currently have with clients evolve around maybe monetary policy is not as effective anymore in tightening financial conditions and possibly getting demand under control. If that narrative gains traction, you could easily overshoot peak rates that are currently priced.
It's amazing how the bias of a market shifts just like that in a day. That was Christian Muller-Glissman of Goldman Sachs about 24 hours ago, talking about the current stance of things, current conditions, and all of a sudden it starts to sound really dated and stale. And I imagine that might change again when we get payrolls at 8:30 Eastern Time, which is 1 hour and 43 minutes away.
The Bank of America analysts describe the stock trading range, and I realize this is applicable to the bond market as well, as neurotic. It is a neurotic trading range, and that is how I feel right now.
This whole year has been neurotic.
I know, I relate to it.
Totally. Equities look like this going into payrolls. Futures on the S&P 500, slightly softer, negative down lower by not even a tenth of 1%. Down by 0.07%. Yields are coming in about 5 basis points on a 10-year, 384.90. If you'd like to hear the estimates, I'm here to provide you with the information you need. 225 is the median estimate in our survey. The previous number was 517,000. The unemployment expected to stay at 3.4%. That's the unemployment rate. And Tom, if you're looking at average hourly earnings, 0.3% is the month-on-month estimate. 4.7 is the year-over-year call. And all of this, of course, going into CPI next week.
I have no idea, but I had no idea 30 days ago. We got a commercial running on Bloomberg Television which shows the three of us dumbfounded, to be blunt. And are we going to be dumbfounded again? Let's get some wisdom on this. And yes, Michael Mayo coming up from her shop, Wells Fargo. We're thrilled. It's who Mike Mayo listens to on the economy. Sarah House joins us now, senior economist at Wells Fargo. No bank questions, Sarah, this morning. What I do is I get non-farm payrolls. I look at the revisions. I take a 3-month moving average. Are we going to get the guesstimate on revisions adjusted today? Are you going to see substantial revisions?
So I don't think we're actually going to see substantial revisions to the January number. So we actually had a pretty strong response rate, or at least it wasn't wildly different from the January averages. So I think there's less scope for that. And so I think what we're looking for instead is another pretty strong number. So 270,000, which is consistent with the jobs market still flying. But at the same time, we don't think hiring can defy the gravity of Fed tightening forever. So we do think a slowdown is in train, and we're likely to see it probably more likely here in the spring.
Your study of history, understanding that banking comes under a Fed purview as well, are the gyrations we're seeing in the land of Mike Mayo right now, do they redound over to your world?
Well, I think what they show is that the Fed tightening has consequences. So we've seen that the economy has tremendous momentum, and so I think that's why we've continued to see such strong inflation, the jobs market holding up incredibly well. But we don't expect to see the labor market remain immune from the tightening that we've seen to date. I think instead it's more that it's taking longer for those effects to be felt, just given that strength of momentum and given some of the many of the unique aspects around the current environment. So everything from the household balance sheets, corporate balance sheets, and so it's just taking longer for that to be felt, but it will be felt.
And Sarah, we were talking about how the move in the 2-year yield yesterday, and frankly continuing today, kind of highlights that the market believes that what we saw with respect to Silicon Valley Bank and some of the other disruptions could potentially allow the Fed to step away from the pace of rate hikes that they had been expecting 2 days ago. Do you think that that's correct?
Well, I think directionally it signals that the Fed does have to be more cautious as we get further into this tightening cycle. So we saw them argue for the 25 basis point hike last time was really supported, that step down was supported by the fact that we have seen quite a bit of tightening already. So 450 basis points through that move, and we hadn't fully felt those effects. And so I think what we're seeing in the markets over the past 24 hours supports that notion that we're getting to more of the fine-tuning stage, that we've done the catch up, but now the Fed has to be a little bit more deliberate in where they go from here.
Do you think that all things being equal, we're likely to see a 25 basis point rate hike, that this basically green-lit just the slower pace, the slower grind as we wait and see what other casualties there are?
Well, I think the debate is certainly not settled on the March rate hike, whether it's 25 or 50. So obviously we've got this big employment report coming up today. We have the CPI report on Tuesday, and there's also a good bunch of activity data, so industrial production, retail sales as well, that we'll get before the next Fed meeting, that I think will indicate whether we have seen momentum really reaccelerate over the past few months, and January maybe wasn't just a blip, or if January was more of a one-off.
Well, Sarah, the thing I'm going to do when this number comes out at 8:30 Eastern time is maybe not look at this month's number. I'm going to that revision column. Might be the first thing I actually look at, Sarah. Are you expecting a big revision at all?
I don't think we'll see a significant one there. Again, the response rate wasn't terribly low for the January number, and I think even if you go back over the past years, you have to go back to 1994 to see a bigger downward revision for January than 50,000. So in terms of a negative downward revision, so wow. I think it'll certainly be important, but I'm not sure we'll get quite as big of a move as people might be expecting. Where ultimately I think the January hot print was driven by that mild winter weather, which that happened. It's not, again, a matter of that response rate.
Sarah House, thank you, of Wells Fargo, on the latest with the jobs report that comes out at 8:30 Eastern time, which seems to have taken second place to what's been developing in the bank sector over the last 24 hours. If you are just tuning in, SVP, Silicon Valley Bank, down by 45%. I think one thing we touched on in the last hour, but probably need to build out a little bit more, is the message coming from the C-suite at this bank is stay calm. You never want to have to say stay calm. But what's amazing about it, Tom, is what the clients are saying. Just VC fund after VC fund turning around and telling their clients to pull their money.
We have a banner up on TV right now I totally disagree with. SVB races to prevent bank run. I disagree with that completely.
Okay, you're going to have to say why. What's wrong with that?
This is the issue. This is a contrived venture capital private equity bank. It's not a true bank. It's a private equity run. It's not a bank. It's never. Years ago, when I drove by it, I'd go out and lecture or talk at Stanford, and you drive by it in Silicon Valley. And everybody back then knew it's not doing mom and pop bank stuff. This is not Jimmy Stewart.
Oh, it's a different kind of bank. It's still a bank, Tom.
I don't think it's a bank. I think it's a private equity VC exercise, as frankly Mr. Ackman mentions this morning.
Okay.
I take immense issue conflating this with other banks.
I don't think anyone is.
I think a lot of people are this morning, and as you mentioned, the stock is down.
That banner certainly doesn't imply that they are. I think it's very unique to SVB. I think the CEO himself would say he's trying to prevent a bank run at this point, isn't he?
I think he's on the phone with how many VC people asking them, begging them not to pull out their institutional-sized deposits.
Sure.
Absolutely.
Well, by definition, then, isn't he trying to prevent a bank run?
It's never been a normal bank.
I'm not saying it is, but it's still a bank.
Well, We could talk about a mismatch in maturities, and this was at the root of some of the issues in 2008. This is not 2008, but when we had all of the structured vehicles that had short-term paper that were backed by long-term instruments, it has a similarity. When you have a mismatch of maturities and you have to redeem on the short end, it could potentially cause revaluation on the longer-term assets. That's really one of the big questions underpinning this.
TK, do you want a final word?
I think Bloomberg Intelligence overnight, Chan and Farrow did phenomenal work on this, and they clearly show, as it's balance sheet Friday, that on their balance sheet is a very unique constructed loan operation to Silicon Valley. But it's not, as Gerard Cassidy said, it's not a bank. It's not a normal bank. It's not,
Tom,
I think
I don't want to get
bank run
into
is
semantics. You can't
inflammatory.
say both at the same time. It's not a bank and it's not a normal bank. You know, it's either a bank or it's not a bank.
I don't think it's a bank. I've
I
never
think we all
felt
understand that it
SVB
has
was a
a
bank.
very concentrated deposit and client base in a very specific industry. I think we all understand that.
I've never felt it's a bank. 15 years ago, 18 years ago, whatever. It's a very unique institution working within private equity, venture capital within Silicon Valley.
Okay, well, it's down now by 44%.
And as you said, it
market.
is the deposits out the door.
Prime Minister of TD is going to join us on payrolls a little bit later this morning. Looking forward to that conversation around 8:30 Eastern Time. Looking ahead to payrolls, if you want the estimates and you are just tuning in for them, 225 is the median estimate. The previous number, of course, 517. The range, incredibly wide. At the high end, 325. At the low end, 80. I think you can fit a truck through that in a major way. Coming into this, just a major move in the bond market, down 5 or 6 basis points to down a 10-year. But the move we've seen on a 2-year note, just unbelievable. A 20 basis point move from New York City for our audience worldwide. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet, with guests like U.S. Special Presidential Envoy for Climate Change, John Kerry.
Climate has no affiliation with any party or ideology. Listen to the scientists. This is not a matter of ideology. It's not a matter of politics. That's the challenge.
Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We're still looking at a labor market that is extremely strong.
This more resilient economy and this more persistent inflation today is in fact pushing the Fed to be more hawkish.
It's all about the trend, and the Fed wants to see a downtrend that's convincing.
The market might be a little bit too fixated on this kind of will they, won't they question of a recession.
I think Powell muddied the water a bit this week, for sure.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
90 minutes away from a payrolls report that is taking second place to action elsewhere through the last 24 hours. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance with equity futures just slightly negative by 0.1%. The attention of the world on one very small financial institution, a bank, SVP, is negative 45% in the pre-market. And Tom, that's where the attention is going into payrolls a little bit later this morning.
Day two of it, but for many people, I think Lisa underscored this earlier, this is a very different bank that has had substantial issues on their balance sheet for not one day, not 2 days, John, but this was seen coming by many, many people that were outside the discussion.
What a trip it's been in the bond market this week to have Chairman Powell tee up potentially adjusting the pace of tightening, introducing the risk of a 50 basis point hike. Some people even suggesting he lowered the bar for 50 and Lisa, the event of the last day or so. Arguably raising the bar again.
I think that that's what the market was suggesting with the move that we saw in the 2-year. Here's the issue. We've been talking about resilience. We've been talking about, are the rate hikes even having any impact on the economy? And it feels like things around the margins and the frothiest sections of the economy are starting to break. And a lot of people talking about what's next.
Does this Fed have to confront financial stability risk before it's conquered inflation? That conflict that's slowly emerging here, they're hoping we don't get a hot print this morning, right?
To the point that we've been talking about, though, no one's really wondering whether we're entering a new financial crisis. This isn't a 2008. So the risk of potentially seeing more casualties of this type of tightening and the Fed not willing to respond because they are fighting inflation is the worst case scenario for risk assets and what a lot of people are contemplating right now.
Certainly introduces a very different dynamic to financial markets. Futures right now down about 0.1%. Lisa's going to run through the day ahead in just a moment. Your bond market set up as follows: your 10-year 3.84%, your 2-year earlier this week, Tom, 2 days ago in fact, 5.08% on a 2-year, right now 4.82.
VIX popped yesterday, John. This is really important. The VIX has been quiescent. The MOVE index, the bond volatility's moved over the week. The VIX was 18, 19, whammo, 23 yesterday in the carnage. Equities have joined bonds.
What a change. 87 minutes away in about 30 seconds, Lisa,
Yeah,
in the payrolls report.
We're going to be looking at the headline number. The range, as you laid out earlier, is got about 150,000 in between the low and the high, with a high of 300,000. The expectation for a lack of revision downward for January, and that's going to be really important. I'm also watching average hourly earnings because the expectation is that they will rise on a year-over-year basis. How much does that keep up the pressure regardless of the headline number? And then, of course, the read-through into the bond market. How do the 2-year yields respond to the quagmire, the rock and the hard place, John, as you were saying, that the Fed is in, that their response to this labor market report will be definitively either a 50 basis point or 25 basis point move, especially in light of some of the turmoil that we're seeing on the skirts of the frothiest parts of the market. Today, President Biden is meeting with European Commission head Ursula von der Leyen. The point that they're going to be discussing is trade tensions, the Inflation Reduction Act in the U.S. Curious to hear how that develops. And then at 9 a.m., Treasury Secretary Janet Yellen will be testifying in front of the House, talking about the debt ceiling, talking about Biden's plan, his budget that he laid out yesterday. Fascinating to see this coming at a time of rising rates, higher inflation. How does she address that, John? I mean, she's got a really tough job selling something at a pretty tenuous moment.
We're looking ahead to the headlines that come out of that testimony a little bit later, Tom.
I'm so glad that we brought up Secretary Chair Yellen. That's what I call her now. I give her 2 titles. Because, John, in the nexus of this, if we get 50 beeps, if this happens, she's got to sit there with Powell and advise on our financial system. Those are two pretty good people to have with a little bit of experience.
Just a little bit. And Tom, then potentially a conversation later on this year about the debt ceiling. That's the last thing they want to talk about right now, isn't it?
What are you doing this weekend? You're watching football, AC Milan won, I get it. What am I doing this weekend? I'm reading Congressional Budget Office. That's how serious this is.
You read CBO reports
I'm reading
over the weekend?
CBO reports over the weekend. Thank you.
Okay.
So does Priya Misra.
I doubt Priya's doing that this weekend. Priya Misra had a global race strategy at TD Securities. Priya, earlier this week, it felt like Chairman Powell had lowered the bar for 50. Did the bar just get raised again?
I don't think so. I think the Fed is spooked by inflation. They are not willing to let the lags play out. I think, they're data dependent. And I think the labor market is strong and there is clear labor hoarding going on. So the labor market's going to be even more lagging than it historically has been. And Chair Powell did say there's going to be some pain. I think we're going through that pain. I think there's a lot more pain in store for us because we think this is going to be a strong report. Wages are going to be high. And I think the Fed has understood that to get inflation, core services ex shelter, down to 2%, you really need those wages to come down. We don't think we're even close to that. So I think, if we get 200,000 today, the Fed's likely going 50, and they're going to potentially then open the door for another 50 because, they just, I would say they downshifted. Now they're back to the pace being a tool. Remember, they de-emphasized the pace, and then now the pace has come back as a tool they're using to manage inflation. So it's tricky. I think this data-dependent Fed is very hard to trade. You just have to be nimble. That's why the market moves 20 basis points.
Priya, in your call of 2022 on inversion, smartest person on the block, I've got to go inside baseball this morning and was stunned 2 hours ago to see that the 2-10 spread, which you follow, disinverted, but the broader 3-month, 30-year bond spread continued to invert. I believe I've never seen that. What does it signal to you when the vanilla spread disinverts and the broader spread inverts?
I think, in terms of monetary policy, I would say the 3-month 10 years telling you that it's restrictive. Why that 2-10s disinverted is we're pricing in cuts in 24, which I think the market actually was a little too aggressive in taking those cuts out. I think the less of a hard landing, or if you have no landing in 23, you're probably having a much harder landing in 24. So I think the more we raise the terminal rate, the more cuts we should price in 24, maybe 25. And the market started to do that a little bit with this whole, financial sector concerns. But I think, if we get a strong number and the Fed follows through, they go 50, they raise the terminal rate. I mean, are we talking 6%, 6.5%? At that point, it's very hard for that 2-year to keep rallying. So I would think that the curve stays inverted. I think some of this was the market extrapolating from SVB into the entire financial sector. I think there is going to be pain. I mean, we should talk about QT as well. Nobody's linking what's happening with the financials to QT. That is tightening policy as well. It's taking deposits out of the system. I think the Fed's telling us they're going to continue with QT. So I think there is more pain ahead, but the Fed is singularly focused on inflation. And so I think they're likely to overdo it here.
Priya, I just want to follow up on what you said. Are you basically modeling out a 6.5% Fed funds rate?
I think the market has to keep that as a decent chance. I think a 6% is quite possible. If they go 50, and then even if they downshift to 25s, by July, you're at 6%. So it's not that hard to see. And, there are lags in the system. I would highlight a lot of people were expecting weak data in the first quarter. We turned neutral, depending on your view on inflation. We turned neutral either in September in terms of Fed policy or December. It's been 3 months since December. It's going to take some time. So our view is the recession is a fourth quarter, early next year phenomena. But the Fed is focused on inflation and they're fully data dependent. They're moving data point by data point. So, I think if the economy is going to slow down too late for the Fed to realize because they're basing it on very lagging indicators.
Well, Priya, how low is the bar then with today's jobs market, with today's jobs report, with respect to raising 50 basis points, especially in light of some of the casualties that we are starting to see emerge?
So I think, financial conditions matter. We also have a CPI report. I would look at wages today. So for today, if we get a 0.4 in 200, 250, I think they're very likely to go 50. But let's look at the CPI report. Let's look at financial conditions between now and the Fed meeting. If there's significant tightening in financial conditions, I think the Fed can then go 25 but raise the terminal. So, they've got different tools to play with. We do get the dot plot, but if financial conditions have only marginally tightened, we get another strong CPI and a strong payrolls. I think the bar is pretty low. Chair Powell suggests that, I think he's maybe regretting downshifting in Jan or that dovish press conference. I think he's trying to overcompensate. So there's a little bit of the Fed trying to figure it out, as we all are, as the data comes out. Unfortunately, the data, I think we're looking at very lagging indicators.
Priya, why are they so hesitant to use balance sheet a little bit more to maybe fast forward, accelerate QT? He's asked about that, and he always talks about interest rates being the primary tool. Why are they so risk averse around their story?
Because these are very non-linear impacts. There, actually, I completely agree with the Fed. I think we don't know how to model how much of the balance sheet is worth how much in basis points. It's highly non-linear. I think the first, 1 trillion of the balance sheet doesn't matter. The second trillion becomes a lot harder. It starts to push real rates higher, like 5 to 10-year real rates move up, deposits flee. How do banks manage that deposit flight? There's capital implications. There's also funding implications. We're seeing that. I think, the SVB might be a special case. But the banking system, for the first time, really is dealing with negative deposit growth year over year. That's a function of QT.
Got to squeeze this in too before you go. You doubled down on that call on the 10-year. Seen massive moves in the 2-year this week. What have you made of what you've seen this week? Has that started to hit your conviction, or are you just doubling down again?
No, I like 10s. I mean, I would still stay away from the front end because the data is still strong. But the 10-year, I think you're setting up for a recession. You're also it's also a hedge against risk assets.
John, did I hear Ms. Misra model 6.50%? Is that a published idea from TD Securities? Did she clear that through McCormick?
And Priya, were you just floating the idea that maybe we go as far as 6?
It's just that the market pricing has to incorporate 6.5. I think the Fed just opened the door for much higher rates.
She does these trial balloons on Bloomberg surveillance.
Is that what that was?
She's trying them out to see if compliance is listening in Toronto. She's just
I don't know if they were awake yet in Toronto. Priya, run. Priya Misra, TV. Priya, thank you. Doubling down on that 10-year call in the last couple of weeks. Your 10-year right now, 3.85. A feeling from Priya there, Tom, that perhaps the emergence of risk in the last 24 hours wouldn't dissuade the Federal Reserve of going big if we get a hot print later.
If she does 50-50 in a 6.5 view, all of a sudden the Bramo call looks brilliant. That's all there is to it.
I think the Bramo call looked brilliant yesterday. Coming up in about 30 minutes, this guy right here, rock star of the financial analyst community, Mike Mayo, senior equity analyst at Wells Fargo, is going to join us at about 7:45 Eastern Time.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Today's U.S. jobs report is likely to help determine what Fed policymakers do when they meet later this month. It's estimated that the economy added 225,000 jobs last month. Now, traders slightly pared back their bets on half-a-point interest rate hike after Thursday's initial jobless claims report. The number was the highest since December. Panic spread across the startup world due to worries about the financial health of Silicon Valley Bank. It's a major lender to fledgling companies. Peter Thiel's Founders Fund and other venture capitalists have advised portfolio businesses to withdraw their money. The shares of SVB plunged about 60% on Thursday. Its top executive is urging clients to stay calm. President Biden and European Commission leader Ursula von der Leyen are trying to avoid a fight over trade. They meet today at the White House. The U.S. and Europe have clashed over the president's clean technology law. The two leaders expected to agree to let European firms benefit from some of the battery subsidies that are offered only to U.S. producers. The leaders of France and the U.K. will seek a reconciliation in Paris today. Emmanuel Macron and Rishi Sunak will aim to turn the page on years of bitter relations between their countries. The issues include post-Brexit ties, immigration, and nuclear power. And Bitcoin is having its worst week since November. An equity sell-off, fear over higher interest rates, and a U.S. crackdown on crypto combined to hurt investor sentiment. Bitcoin fell below $20,000 today for the first time since January. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
DOJ or other authorities.
Could face bigger challenges.
What's next?
Was going to keep rate while come. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Last month's jobs report caught everyone off guard.
The unemployment rate falls to 3 point. Oh my goodness.
That is what we call, TK, a blowout jobs report.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
I'm sorry, it's still fully employed America.
Jobs are plentiful. Wages are going up.
How much does that increase the rate hiking expectations in markets?
The February jobs report, today on Bloomberg Television and Radio.
Is this SIVB situation going to create easing or even more tight lending standards? So the problem that the market has isn't necessarily just SIVB. It's where are you going to get the money? The sources of increased money to buy things, do things, invest in things is really drying up.
Tony Dwyer, not a big fan of this market right now. The chief market strategist at Canaccord Genuity going into payrolls 1 hour, 13 minutes away with your market set up as follows. Equity futures just slightly softer. No real drama here. We're down by about 0.1%. Yields come in 6 basis points, 384. We've really backed away from 4% in the last couple of days, particularly yesterday on a 2-year yield, backing away from 481. Down 5 or 6 basis points this morning, adding to the 20 basis point move we saw yesterday. The estimate for 8:30 Eastern is 225. There was a feeling that we needed 225 and maybe a 0.4 print on CPI, and we were going 50 at the Federal Reserve. And I can tell you now, everyone is very, very confused about how high or low the bar might be for a 50 basis point move around payrolls. So if you get one of those middling numbers, it's going to be like, what do you do with that? What should we do with it?
Let's discuss this right now, because Priya Misra was great. If we get 50-50, as she didn't predict or forecast, but as she alluded to, that's 100 beeps in 6 weeks. That's a wow statistic for American banking.
What kind of data do we need to get that 50? Lisa and I have talked about this earlier in the week from Citi and Andrew Hollenhorst. They're looking for 255 today on payrolls. They're looking for 0.4% month-over-month CPI next week. They think that's sufficient still. Now, from an economics perspective, I think a lot of people might share that view. From a market perspective, given what we've seen, some of the de-risking in the last 24 hours, I think if the Fed decision was tomorrow, and it's not, of course, but if it was tomorrow, they'd have a very difficult decision to make.
And to me, it's off revisions. And Lisa, Sarah House made clear she does not see substantial revisions off that 500,000 statistic at Wells Fargo.
That's been one of the biggest issues for Fed Chair Jay Powell, because the revisions have been hot, right? So they basically had to revise up their expectations. I would argue that if they go 50, after what we've seen in the financial sector on the heels of a hot labor market, that would send a pretty daunting and cold message to this market, because what it is saying is the Fed put is dead, or the Fed put has been lifted to such a high degree that it's not going to come save you. Don't even look for it.
We've got one goal, get inflation down. It would send a pretty strong message. Tom, SVP, we followed it all morning, all yesterday. It's down another 41% this morning.
41% off 60%, so you do the math, and that's something like 36% left over after 48 hours. Joining us now, our chief bank correspondent. It's her fault. Shonali Bassick checks in this morning. I want a link of these 3 bank stories and which one is not the other one, you know, Sesame Street and all that. You've got a unique bank out in San Francisco. You've got a unique bank. I get the S's mixed up. The one that's going on, the one that they're in work on.
Silvergate is
Silvergate.
the one liquidating.
So those 2 are really not banks, maybe, but Signature is. How many Signature banks of New York are out there?
There are a lot of them, but remember, Signature, the reason you're talking about it and worried about it at all is because they had some linkage here to the cryptocurrency industry. They had about 15% of their deposits tied to the crypto industry, but they have issued updated guidance here to kind of calm nerves of the market.
Yeah.
All deposits, as you guys have been talking about all morning, are not created equal. And so you're sitting here and they're telling you that those deposits tied to the crypto industry are going down. They are not signing any alarm for caution, but we've been talking about this for 24 hours. If you're a smaller bank in America, you're worried for a lot of reasons. But again, I think the thing that's more concerning to me is people were not looking at the ripple effects. If the cryptocurrency industry is under pressure, why is it surprising that their bank is under pressure? If the technology community is under pressure, then wouldn't Silicon Valley Bank be a derivative effect of that? Remember, Silicon Valley Bank banks half of U.S. venture-backed startups, and not just that, their founders as well.
Interesting.
And so you're seeing here the ripple effects of the bubble popping. And I think what's a hard thing, and what investors have clearly not wrapped their head around, is what other derivative effects are there?
Is this an opportunity, and I go to the legacy of Mary Meeker and Morgan Stanley, or frankly the other major banks, is this an opportunity for them to go in crisis in Silicon Valley?
Listen, Silicon Valley Bank, the reason we watch it so closely is because it was such a darling. It was such a beloved bank. Goldman executives, time after time, have told me they wish they could own it. It was just too expensive for so long. The thing is, the question with Silicon Valley Bank is this an acquisition target after they've faced these kinds of deposit runs already? You have people like Founders Fund drawing caution at this point. You have individual founders, not just the companies, pulling money as well. And so those relationships, the bankers, remember, they've added so many bankers across many banks to build investment banking franchises for Silicon Valley Bank as well.
What's so great about you, Shonali, is you have so many conversations with executives of banks of all sizes, and I'm curious whether perhaps you're not hearing catastrophe, imminent demise kind of feelings, but you are hearing concerns about profitability, concerns about how to lend effectively, concerns about deposits leaving the bank. How much is that becoming the dominant conversation in the C-suite at some of the biggest banks right now?
It's a huge conversation. The deposit conversation has been an issue since, let's say, November, December of last year. When I sat at Goldman during their financial services conference, that worry about smaller banks really started to bake in. You're not as worried about that deposit impact for the bigger banks that are more diversified, that don't have to sell their maturities, sell their securities at a loss, as you've been seeing at these other banks. This is a balance sheet problem. The other thing, remember, I think another kind of cautionary tale here, a lot of this was set off by Silicon Valley Bank saying that they were going to raise money. I think when you're looking to the capital markets, if you're asking investors for anything at this point in time, you have to be really careful about what the use of those funds are and what the reason is, and whether it's signaling caution or whether it's signaling any potential sense of growth getting out of this period. Because if they smell blood at all, investors will run.
Do you hear about selling portfolios of less liquid assets? And I say that because that was also a piece of raising money, and that has a broader market effect as well. Is that something that's more on the table?
It is, and that's what happened with a lot of these banks. They've been having to sell securities at a loss, and that is a problem. And by the way, this is not just treasuries. These are mortgage-backed securities.
Of course.
This is where it all comes full circle again. And again, you're selling at the wrong time. So then you have a management question about balance sheet preparation. I would say one more thing, guys. Remember, there's so much negative sentiment in the market. I think back to a conversation I had with a senior executive at Goldman who kind of led the Big Short, and they reminded me that the money they made going into 2008 was not just shorting the mortgage market, it was shorting financials. And so if you take a look at the European financials, the CDS trading today, and you look at kind of the put options rising on a lot of these banks, this is such a big sentiment story. But will another bank or two face dire issues in this crisis? JP Morgan became JP Morgan from what it bought during 2008. And you have to wonder whether you're going to see moments like that again.
Can we just squeeze this in with SVB? Mm-hmm. You framed how important it is to that ecosystem. Why are they going out of their way to undermine it?
So that, if you look online, it's very interesting. There are a lot of venture capitalists defending Silicon Valley Bank as well. The behavior here of Silicon Valley to just leave somebody that was there for them when nobody else was. I mean, there's the same kind of frustration when it comes to Signature Bank as well. So to your point, there are a lot of venture capitalists out there saying, do these guys have nothing else to do than talk about potential bank runs? And should they not be causing such alarm over dinner last night?
Maybe they just want to cheapen the valuations. They can swoop in and buy it.
Or get the Fed to back away. I mean, the really cynical person might say.
No, that's been an absolute concern.
It's bizarre. Shonali, thank you. Really complex stuff. Very unique issue. Shonali Basak there on the latest. And all of this going into payrolls, which is about 35 minutes away. Alan Zentner's going to join us shortly from Morgan Stanley. We'll talk about how high or how low that bar might be for a 50 basis point move from this Federal Reserve. But that testimony already feels just that little bit more stale, Tom, in the last couple of days.
I think we need a third day.
Third day?
Third day would have done it.
What would the walk back look like on day 3?
I have no clue. Leave me alone. Give me a drink.
Are there any Fed speakers this morning or this afternoon?
It's the final day if they want to talk. It's the last day before the quiet period, going into the March 22nd Fed decision. CPI March 14th, so that's next week, and payrolls just around the corner. Alan Zentner and Morgan Stanley coming up next. Futures, just a little negative.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
60 minutes away from a much anticipated payrolls report until like yesterday, and then things changed very quickly. Equity futures on the S&P down about 0.1% on the S&P right now, and the Nasdaq positive by 0.1% on the week so far, heading towards a week of losses, down about 3% on the S&P 500 so far this week. The banks have been absolutely hammered. The much followed KBW Bank Index 4-day losing streak close here, worst week for the KBW Bank Index, going all the way back to spring 2020. It's been a wild ride, Tom, in both equities and the bond market too. You look at this 2-year yield, TK, where we've been this week, 5.08%. 2 days ago, 4.79 right now, and down about 8 basis points this morning.
210 spread, 111 beeps, and we've come back in with disinversion to 96 basis points. I can't even do the math, John. I think it's 15, 16 basis points of inversion. So it's not only the level analysis, which people like Ellen Zentner have been great at, but it's the rate of change analysis going on.
210s right now, as you point out, Tom, negative 96, all the way back from 110, pushing 111. After the ADP report from a couple of days ago. And we've backed away because the 2-year yield has come all the way back in. A 20 basis point move yesterday, another 8 basis point move
nice chart there
this morning. Just an unreal move, TK.
Yeah,
Off the back of the risk aversion. There's just a belief that Chairman Powell lowered the bar for 50 and the market events yesterday raised the bar for 50.
And I'm going to also say, we can argue about bank runs and all that, but the reality is it's not that it's one bank. I believe we have 3 banks in the vista into the weekend, and maybe there's more we don't know about. You know, I mean,
there's a
it's
who's
some
next
of it.
feel to it, I get it. But if you just, you know, cool minds will prevail, all of that good stuff.
Yeah, well, it worked at Tottenham.
Whatever. Bramo's going to talk about SVB in a moment. I just wanted to give you Betsy Graysick's latest over at Morgan Stanley. Fantastic bank analyst, says this: we want to be very clear here. We do not believe there is a liquidity crunch facing the banking industry. The headwind for the banking industry is that the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue, and EPS as well. So we're going to have this conversation all morning. We can talk about idiosyncratic, unique issues, existential threats, all of the above. That does not mean that what's happening elsewhere is not worthy of attention, because it is. There's a profit problem emerging here for some of these big lenders.
That's really the issue. It's the profit issue. And yesterday you saw that when the KBW index was not just SVB, but it was also JP Morgan, Bank of America. Today, they're clawing back losses in pre-market trading. They're basically trading flat. The major banks, SVB, not so much, down another 44% after yesterday's 60% drop. We're going to be watching this, not just to see how far the stock will fall, but also what it means for the depositors and what it means for being a possible acquisition target. Also, the lack of attention from regulators in terms of taking it over or ameliorating the situation in any way, shape, or form for them. Speaking of Silicon Valley and the potential casualties, let's talk about Allbirds, because that was the maker of Silicon Valley's favorite shoe. And they just came out with earnings, and those shares are lower by 21% after they had fourth quarter net revenue that missed estimates. And then they were also looking at negative projections. Those the stock of that company has fallen more than 80% since its IPO in 2021. Well, that was the darling of the
John,
Silicon
do you
Valley.
have those shoes? I don't have those.
No, but
No,
remember, everybody had them.
yeah,
Ashton
that's
Kutcher was sort of like
Are
the
they
poster
expensive,
child.
or they're just made in a very nice way?
They're very nondescript, so it's sort of like humble money, I think, is sort of the idea.
Stealth
which is
wealth.
Stealth
That
wealth.
fits
That's
right
sort
in,
of this
yeah.
feeling.
Stealth wealth.
That's just what I'm saying. Also,
Stealth wealth to me is like Brunello. Cucinelli, but it's Allbirds apparently on the West Coast.
well, that's, you're talking Europe, you're talking U.S. We can discuss all of that at another time. But I'm also looking at Oracle because they came out with earnings after the bell. You're looking at those shares lower by almost 4.5%. Basically, expectations were so high. This really speaks to the existential concern around whether we have overpriced cloud adoption and the revenues from that. And so you're seeing, even though they had pretty decent results, the fact that they didn't come in with the higher estimates are setting their shares lower.
Amid the banking discussion, amid this historic jobs day, we find calm with Ellen Zentner, the chief U.S. economist at Morgan Stanley. You published a couple days ago. I'm going to guess you'd publish differently this morning. What would you publish this morning on the linkage of the Fed, the triangle of the Fed, to the data we're going to see, jobs and inflation, and to the turmoil we see within the financial system?
Look, I think that I've been seeing investors in Europe, in South America, arrived back to New York yesterday. Throughout that trip, investors' views of what the data meant and what the Fed would do changed every day and almost meeting to meeting, where the bar for the Fed to go 50 basis points at the March meeting seemed pretty high. And then all of a sudden it's ultra, ultra low. I think that we're at a turning point. We're at a turning point, and we're talking about credit markets, right? We're talking about tighter credit conditions. We're talking about all these things that do show that rate increases are starting to flow through and impact liquidity in the economy and just spending, all of that, right? The Fed should wait for all of that. They should stay in this risk management mode. I think they want to stay in this risk management mode, that you can get rates as high as you need to get them, but you approach it more slowly. Will they get dragged into 50 because the market is pricing certainty of 50 basis points and you don't have a lot of appetite to push back against that? And I think that's the question. I mean, my fingers are crossed that the data is, I mean, I can't call 190,000 payrolls weak. That's our forecast. But I pray that it's about in line with that and the market comes to its senses. The Fed does not want to do 25 here, the bulk of the Fed, right?
You think they want to pause?
Yeah. No, I don't think they want to pause. I think they want to stay in this risk management mode of a more safe approach to peak, wherever that peak is. And you go back to 50 basis points in March, on whatever this data looks like, the data may not look much different before the May meeting. And then what do? You do another 50.
This is a painful exercise, isn't it? And this is a really difficult one for you to answer, so forgive me, but I've got to ask it. How high or low is the bar for 50? What number gets it done today and next week on the 14th?
I think a 250, I think a higher than 250 for headline payrolls. And I think core CPI that in the components that matter, so the core services stripping out housing and medical, where again you get a third straight month then of no slowing there. I think that could do it. This is a tricky time for the Fed where there's not a lot of chance to communicate with markets if they want to push back. If the market sees the data and the market is going to price certainty for 50 basis points in March, I don't know that there's going to be a lot of appetite for the Fed to push back against that. That's a really tough job to do on a tight timeline. And you can see with the changes in financial conditions, the market's saying the world's not going to fall apart if you do that. But if you dig into pieces of of market pricing, the market is saying, hey, you better go 50. And oh my God, if you go 50, there's going to be a recession. We're seeing that pricing in parts of the market.
Well, but to that point, what is the potential casualty coming from Jay Powell's signaling of a 50 basis point rate hike? In other words, if they don't go 50, does that essentially lead to an easing of financial conditions, stocks rallying, spreads coming in on credit, all of these things that they look at as the transmission mechanism or one of them of their policy?
Yeah, so if the market is pricing 50 as a certainty and the Fed surprises to the downside on that, then you will get easing in financial conditions. And when we are in this inflation environment, and the Fed is still closely following inflation expectations, market-based measures, business and other surveys, you run the risk that the inflation markets say, hey, you're not doing enough again, right? And so they run that risk. And that's why I think that it's not that the market is leading the Fed to do 50 basis points. It's that they're all looking at the same data. The market has moved more quickly than the Fed. The Fed probably won't push back and says, yeah, we're sort of cuspy here on whether we can stay at 25s or not, and goes ahead and delivers 50.
Earlier this year, you were talking about a soft landing scenario or something that was a bit easier than the worst case scenarios of last year. Is that changing for you now?
I am still in the soft landing camp. I know it wasn't a very popular view last year, but how long can you have very strong payrolls and still think that you're going to go down the tube? So I am still in the soft landing camp. I'm still that the soft landing may not feel so good. We're at 0.4% GDP Q4 over Q4 for this year. Hey, that's a 10th higher than when we came into the year and thought we'd be at 0.3. But I will say that qualitatively or subjectively, the odds of recession do go up if the Fed is going to move back into a higher gear here and move at a faster pace.
John, we got to look at the markets here quickly with Ellen Zentner. They're moving. There's no other way to put it. Equity markets were south, and they've gone souther recently, and the yield space moves.
That's a 30 basis point move on a 2-year. in the last couple of days.
Yeah.
And by the last couple of days, I actually mean 2 days.
Yeah.
We topped at 5.08%, and we're back down to 478.
It's going to break down right now.
On a 2-year. It's quite a
Yeah.
move, Tom.
We got a headline out, Saudi Arabia confirms deal to restore ties with Iran. I don't know if I can link that into it, given all the
Seen one
turmoil.
report. I mean,
There we go. We just break down.
I wouldn't do that right
Yeah,
now, but I think that
477.
headline is interesting on its own.
Yeah.
That Saudi and Iran agreeing to reports, Tom. According to reports, agreeing to reopen embassies within the next 2 months.
NASDAQ was green. It goes to the red here slightly. We'll follow that with Ellen Zentner of Morgan Stanley. I look, Ellen, at this jobs day, and Priya Misra was on from TD Securities, and she's looking at the sequence of being bold. Is this an Arthur Burns Fed, or are we still measured a la Greenspan?
No, I don't think it's a. And look, I know why some on the FOMC might not like the idea of moving down into the 25s and just staying at a steady 25s, because then you run into the Greenspan criticism that it was sort of this measured pace and you didn't have the impact on financial conditions. Nor do I think, I think Chair Powell's made it clear he's not going to be named an Arthur Burns, right? He's going to be Volcker. He wants to err on the side of too much. You can err on the side of too much and do it at a pace of 25s, right? That is the safer approach to peak. And I very much believe that the bulk of the FOMC would like to stick with that. It's just that we are at a turning point where the data is still looking mixed and strong, but other variables, other elements of the economy and financial markets we're following are showing signs of cracks. So don't stop, but just you don't need to speed to peak quickly here. And unfortunately, they sent this message to markets. They got markets to accept that it was going to be 25s from now on.
Yeah.
And now that's called into question. So it's rate volatility. At the end of the day, that's what we're going to be saddled with. Because in every single meeting, now it's going to be: do they go 50? Do they go 25? Do they not go? But for right now, we're watching the totality of the data, as Powell is. Everyone's got a different definition of what does totality of the data mean. I would say even on a headline payroll, let's say it's a 250 payroll headline, but you've got participation that's picked up, and because employers are finding it easier to hire, wages come off faster. That is the totality of the data. It makes it harder to discern exactly what the Fed would do on that.
You're diplomatic. It wasn't just the downshift. I mean, they could have stuck with 25s. He just sounded less and less like Volcker from Brookings onwards.
Yeah.
That didn't sound like Volcker. And I said earlier this week as well, the speech at Jackson Hole stood the test of time. And they could have downshifted and gone down to 25 and kept saying those words. But there was a language shift as well in the last couple of months that didn't stack up.
Balance of risk seemed more balanced until it didn't. And then all of a sudden we're flipping and flopping and super neurotic.
Ed, and I say this every month, but you're awesome. Ellen Zentner and Morgan Stanley. Ellen, thank you. Just amazing to hear Ellen say, I hope we get 190.
I know.
Like 250
That would make
plus.
me super neurotic.
Yeah. 250 is a problem. Mike Mayo of Wells Fargo is coming up shortly. You don't want to miss this conversation. Just a rock star of the analyst community on financials. That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a big gain of 517,000 jobs in January, all eyes will be on today's employment report. Another round of hefty payroll numbers could cement the Federal Reserve's resolve to hold interest rates higher for longer. Economists predict 225,000 jobs were added last month. But there are signs the Fed hikes are taking hold, with jobless claims rising to the highest since December. Donald Trump is likely to face criminal charges in New York. According to the New York Times, the former president was told he could appear before a grand jury next week if he wants to testify. That's said to be a sign that an indictment could soon follow. The case has to do with the former president's role in paying hush money to a porn star. In Ukraine, President Volodymyr Zelensky is accusing Russia of deliberately targeting a nuclear power plant. The latest missile barrage knocked out its power for a 6th time, as Zelensky called for sanctions to be placed on the Russian nuclear industry. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Largest banks go through a stress test every year, and the banking system has been fortified very strongly since the financial crisis. Now, even the smaller banks, they too go through a very rigorous regulatory process. Now, granted, we all know uncertainty creates fear. That's what we saw yesterday. As cooler minds prevail, I think things will stabilize and people will realize that this is not a 08, 09, or even a 1990 moment.
Gerard Cassidy there of RBC Capital Markets. Let's get straight to the chart. The number you want to see this morning, SIVB is down 48% in the pre-market. This is Silicon Valley Bank. It is down 48, pushing 49% lower in the pre-market, 54.30, and this is off the back of a move we saw yesterday, a move of some 60%. Mike Mayo is going to join us shortly, Tom, from Wells Fargo. The standout quote for me from his note right at the very top, he said, SIVB is the worst case. The core issue at SIVB is a lack of funding diversification. We've made that point repeatedly through this morning. Most SIVB deposits are from VC, which has its issues. To us, the larger the bank, the more diversified the funding. That's Mike Mayo of Wells Fargo in the last 24 hours, Tom.
Let's not waste any time here. Joining us right now is Mr. Mayo, senior equity analyst at Wells Fargo, iconic on the street back to days long ago with Credit Suisse. Mike, I've got 8 ways to go here, but I want to just simply say, is this morning the opportunity for the major banks to get competitive ground? Do the major banks benefit by all this turmoil because financial America will find comfort with big banks?
Well, the unintended consequences of everything that's taken place since the global financial crisis is it's increased the moat around the largest banks. So the regulation, the reduction of mergers, the too big to fail, all of that simply has reinforced the resiliency of the largest banks and resiliency of the balance sheets. Credit risk is much less. The resiliency of the business models, the scalability that you've gotten from technology, and yes, the resiliency of the funding. Even though deposits are declining some, we think the deposits are quite sticky at the largest banks, and they have all sorts of ways to fund themselves. So, you know, the issues out there, that you see it in the stock price declines for the largest banks, are way overdone. The Fed stress test is conducted each year, and this year I see it as the combination of the last 3 recessions combined. And until banks can pass that test, they're not allowed to return capital. The issue of the moment is banks do have some unrealized securities losses. You know, that's already reflected in their financials. And even if you assume they never sell these securities, deposits are still about 20% higher relative to loans than they've been historically. So since the global financial crisis, you know, capital is up 50 to 100%. Liquidity is up about 50%. The credit profiles are vastly improved. Subprime loans are 80% less than where they were before. And Tom, as you know, I was fortunate to be the first analyst to testify on the causes of the global financial crisis to the Congressional Committee. And, you know, as you know, I got fired part of that time when I was negative.
That worked out.
Well, it worked out in the end, not in the moment. But this is almost like the opposite of the global financial crisis, when there were not fears, and then things were about to crumble. And now the fears are really, way out there, when the banks are more resilient than they've been, in a generation.
So, Mike, we can talk about the resiliency. I think we also need to discuss the profit headwinds as well, net interest margins, how much they'll have to pay for that deposit base at the largest lenders. In just a moment, Mike, before we get there, I want to pick up on something you said. You said the moats around the biggest banks are huge. What about the smallest banks, Mike? How vulnerable are they? Have we seen, and can you comment on the lack of regulatory scrutiny that they've received over the last 10 years?
Well, the entire industry has had additional regulation and oversight. And so those industry statistics that I quote include both the small and the large banks. Now, you can always have idiosyncratic events, and that's going to happen. I mean, and I think one warning here is the risk outside the banking industry. So you have issues with crypto, and that can have a ricochet effect. You have an issue with VC firms not fundraising as much, needing to draw down their funds. That can have a ricochet effect. But really, I think what's not been seen yet, and I think you could see more, are bigger problems outside the banking industry, as so much risk has been pushed outside of banks into non-banks.
Which banks, which of the biggest banks, are most exposed to a devaluation in some of the assets most exposed to those areas? And I'm thinking of private credit. I'm thinking of less liquid loans. I'm thinking of some of these industries that are seeing some serious distress.
Well, the truth is, and this goes back to the Fed stress test, every year the Fed is recalibrating the most risky areas. So the penalty for Goldman Sachs having private equity investments has gone up and up and up the last few years. So you have big capital behind a lot of those types of investments. So the entire industry has become much more resilient. So you have four categories of loans. One is consumer secured, those residential mortgages. You had that crisis in 07, 08, and that's not happening now. Loan to values are great. You have unsecured consumer and credit cards are an area to watch. You're seeing issues on the low end, auto loans, low end consumer. And then you have on the wholesale side, secured, that would be commercial real estate. That is an area to watch, especially offices. So we're watching that. And then you have the unsecured wholesale or commercial loans, and you have leverage loans, and that's also an area to watch. Having said all that, this is really more of an earnings issue, not a liquidity issue, not a solvency issue. We've taken our estimates down on some of the banks due to higher funding costs. And if anything, so far, credit quality has performed stronger for longer than I or many have expected. And that's still likely to be good in a good economy.
We started out by talking about how, in some ways, episodes like this consolidate control, consolidate market share among the biggest banks. Which among the big banks will emerge as the winner from all of this, especially because that really determined the winners and the losers of the last crisis?
Well, you have seen a theme of Goliath is winning when it comes to capital markets. And it's really amazing the impact of regulation. I mean, the likes of Goldman Sachs and JP Morgan consolidating wholesale market share. And on the retail side, you've seen the likes of Bank of America really lead the way with retail banking, gathering share. JP Morgan has also gathered shares. So when these rules come out saying, okay, banks don't merge anymore, I mean, it's like the Jamie Dimon Protection Act. It just increases the moats around that business. And I think that's one of the unintended consequences of regulation and probably should be reconsidered.
Mike, I've got to squeeze this in just quickly. It's just on the challenges that KeyCorp mentioned earlier this week. Is that not a profit headwind for some of the big names you just went through?
Look, funding is going up, and last time I was on the show, I know Lisa asked me, when are we getting paid more for our deposits? Well, you're getting paid more for your deposits now, and so look, the additional funding cost for the banks. Look, this could wind up taking 5 to 10% out of our earnings estimates. On the other hand, the recession discount is about a 30% factor. So if you give up 10% of earnings but get that 30% valuation back, then that I come back a year from now and you say, wow, the banks actually performed well after all.
Mike, appreciate the hard work as always, and thanks for getting up early for us this morning. Mike Mayer there of Wells Fargo. If you consider 7:55 Eastern Time early, which of course we don't, I can't help myself, Lisa. I can't help myself. I think it's important, Tom, we draw a distinction as we have done all through this morning. And this is just an observation, not a judgment about where this is going. But it's interesting to see the market draw a very clear distinction between the big banks and what's happening with SVB this morning. SVB's down more than 50% now in the pre-market. Let's pick a bank, any bank. Bank of America in the pre-market is down just 0.2%.
I looked at it very carefully, but you nailed it with KeyCorp. Full disclosure, got a family relationship there. Cleveland, Ohio, 17,000, make it 18,000 employees. And I looked at it, and the downdraft in the super regionals or the regionals compared to 2008 is a cup of coffee. We need to put in perspective, this is not 2008.
Futures right now just about unchanged as we count you down to payrolls. 34 minutes away. The payrolls report just around the corner.
Oh, yeah.
Welcome back to another BNP Paribas Open update for Bloomberg TV and radio. From Tennis Channel, I'm Erin Coscarelli. Former U.S. Open champ Daniil Medvedev headlines Friday. The 27-year-old heads into the 5th major on a red-hot streak of form that saw him take out Andrei Rublev to lift the trophy in Dubai last weekend. And the 5th seed, certainly the man to beat in the desert. And don't forget, you can watch all the action exclusively live on Tennis Channel. I'm Erin Coscarelli.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounded like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index. Wow. But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool, and I don't want to move to the suburbs. Like,
this episode is just Joe taking advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live, and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet, with guests like U.S. Special Presidential Envoy for Climate Change, John Kerry.
Climate has no affiliation with any party or ideology. Listen to the scientists. This is not a matter of ideology. It's not a matter of politics. That's the challenge.
Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
We still don't think we're through this period of volatility.
The market has repriced the peak rate for the Fed, for the ECB, and it looks much more symmetric.
We expect to see job growth slow. We expect to see some moderation from interest rate hikes.
I think it's very hard to look at the data and say with confidence we know where we're going. It's noisy.
The economy has changed structurally. There's so many things that are different than they were in 2020.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. On the oddest of days, it is a jobs day. We'll bring that to you in 30 minutes. It is, well, some form of run, dash, or whatever on the American financial system. We've looked at that this morning with Gerard Cassidy, Michael Mayo, Shadali Bassick, and others. But the best we can do is in this moment give you the markets. And John, you've talked up the 2-year yield right now down to new lows and almost breaking through where we were at midnight.
High of this hiking cycle, the highest since 2007, 5.08%. That was 2 days ago. Right now we're down to 475, call it 476 on a 2-year, down another 11 basis points after a 20 basis point move yesterday. What you heard from Ellen Zentner and Morgan Stanley 15, 20 minutes ago on this program is remarkable. She's looking for 190,000 on payrolls in 29 minutes and hoping it's not larger. Hoping that jobs report is not bigger because she is worried this Fed gets dragged back into doing 50 basis points, Tom, and causing too much damage.
What we're going to do on radio and television is slow it down right now. Nadia Lovell's going to join us. We're going to get to her in a moment, but we need to gather perspective here over what we've learned over the last 5, 6, 7 hours. And to me, John, the absolute unique thing here is the linkage of Chairman Powell into this financial challenge that we face right now.
And the prospect of real policy conflict.
Yeah.
If they get dragged into backing away, never mind getting drawn in to do 50. Let's say the data screams 50. Strong jobs report, who knows? May or may not get it. Hot print next week on CPI, who knows? May or may not get it. But let's say it screams 50. At the same time, you have some of these banking issues. I don't care how big the lender is. If it's a small institution on the West Coast, whatever, there's no way that committee wants to sit around a table and talk about hiking interest rates 50 basis points with this kind of thing developing, Lisa.
Absolutely. And I think this, to me, is one of the big tests for a Federal Reserve that hasn't been that sensitive to the market response. They've seemed to shrug off trying to manipulate markets or direct markets, and they're saying, we're just going to look at the data. And they haven't necessarily responded as forcefully as people have in the past. So in this case, are they also going to shrug off some of the alarm signs that that we were hearing about from Ellen Zentner and just say, well, the data is hot, we're going to go 50?
Just some observation here for the two of you to dive into. Priya Misra in conversation frames out 50-50, looking for the first time, John, at 6.50%. She's on air, and George Saravelos at Deutsche Bank is talking up disinflation is here and looking at the 2-year law to take the 2-year to a lower yield, higher price. I mean, that's not the comedy, but the jumble that we're living right now.
What is sufficiently restrictive for the economy and what is sufficiently restrictive for the market? And they can be two different things sometimes. You mentioned the possibility of 6. Rick Reeder at BlackRock's going to join us in about an hour on Bloomberg TV and talk about the possibility
after the report
of getting to 6. Tom, we were at 0 12 months ago. I think often we forget that. It's important to frame that. We were at 0 12 months ago and the Fed was still winding down QE. QE and 0, and all of a sudden we're talking up 6, 12 months
What
later.
did spreads do yesterday? I haven't even looked. I've been so busy.
That's exactly where I wanted to go. We did see some spread widening. We saw about the biggest 2-day spread widening in risky credit going back a couple of months, right? This isn't anything to
the
write
VIX went
home.
out as well.
But it's not, crisis. Here's my question. We've seen really anemic trading volumes in some of the riskier credit. We have not seen true price discovery at all for private and non-traded items. At what point do we start to see price discovery, and does that change the narrative in a new way? When you start to see forced sales, that's when, whoever said it, Warren Buffett is the person who is usually credited with it. When the tide rolls out, you see who's naked.
We're going to start the data check here to get to Nadia level. John, I'm going to go to the Bloomberg Financial Conditions Index, which was shockingly accommodative. You mentioned yesterday or the day before how odd that was. It's over. We have moved from a positive standard deviation to a negative 0.01. I'm going to use the word massively restrictive on a 2-day basis.
And that steepening, or as you call it, Tom, disinversion, driven by the front end of the curve. Just this massive bid came back into the 2-year yesterday, continues this morning. On a 10-year maturity, we're down about 7 basis points. On a 2-year, we're down big time again. We're down 8 basis points on top of the 20 basis point move from yesterday. Remarkable stuff, Tom, just remarkable. Lisa mentioned that quote from Warren Buffett. I love those kind of quotes. Those lines. Margin Call with Jeremy Irons. Love that movie. Damien Sassoon was listening a little bit earlier, and he said there's this line that comes from the character that Jeremy Irons plays. If you're first out the door, that's not called panicking.
That's
Isn't that a great line?
Well, that's,
if you're first out the door, that's not called panicking.
You hear the golden retriever thing?
That's right. That's right. That's it.
Do you know what I love? I've seen YouTube
you remember
stuff.
The scene?
I've never seen the
She's
movie.
At the end of the table. That's a fantastic movie.
I've seen the YouTube things. Jeremy Irons, with his hands, he absolutely nailed what we do. His hands in those board meetings is exactly what it's like.
Just an awesome performance, Tom. Awesome.
There you are, your movie review of this morning. Movies with John. Right now, saving the day, Nadia Lovell joins us, senior U.S. equity strategist. Nadia, you and your team have to write, given what we've just discussed. How does your research note change as you publish for Monday?
We're not changing much because I would tell you, Tom, high interest rates wouldn't really matter. And while it might take some time for you to see the broader impact, there will be impact. And we're starting to see that. We saw it last year in the housing market with higher mortgage rates, in fact, in affordability. We're now seeing implications for the financials market as well and what it could mean. I mean, we've been looking at very closely at the Senior Loan Officers Survey. We've seen the recent one, additional tightening in credit lending standard, and we think that that's going to tighten further. We know that credit is a lifeblood of this economy. So we really think that the snowball, the headwinds have been building. And while the fact that we saw the warmer weather might have kept some of this at bay, we do think that the storms are brewing. And so when we look out into the back half of the year, we continue to think that the risk is skewed to the downside, Tom. I mean, in fact, just a few weeks ago, we further lowered our S&P 500 target for year end to 3,800.
So, Nadia, we've had people come on all morning saying there's an opportunity to buy the big banks. Do you disagree?
We disagree. We actually downgraded financials in December into strength to an underweight. And what you see playing out right now in the market was something that we were concerned about. We were concerned about deposit beta and increase of deposit costs. We think that we're still in the early innings of this competitions for deposit. We're just now seeing the accelerations in deposit beta and outflows. And reality is no one is immune. So we think that this will continue to have implications for profits and margins are going to get squeezed in this environment. So, today's issue might be deposit betas and outflows, but tomorrow's issue might be net charge-offs. Yes, credit quality remains benign right now, but the normalization process is happening, and we could see an acceleration in that if we see a deterioration in the macro backdrop and if we see a pickup in the unemployment rate. We're all watching for payrolls coming up.
Just to build on that, Mike Mayo of Wells Fargo was on just a moment ago, and he was talking about how some of the concern and the stress will only consolidate market share and power among the bigger names. That yes, there could be a decline in profitability, but they can overcome that and compensate for that with more business. Does that resonate with you? I mean, are you starting to look at some of the strongest bank names for when perhaps there's a bit more pain and then you can take an opportunity to buy them?
Yes, I mean, you saw that in the financial crisis, and we're not saying that this is a financial crisis that's happening this week in the banks. And so we do think that the larger banks are likely to get larger and pick up some market share here. So you want to be in those quality banks if you're going to own banks. I mean, yes, get your shopping list ready, but again, we don't think that the downside is over yet. But maybe in the back half of the year and into 2024, you want to look at those more quality banks that has more sticky deposit base and also a more diversified business.
And Nadia, none of us have a crystal ball. We don't know what that jobs report's going to be. I think the administration knows. They get told about 24 hours before, the night before, so they know. We don't know. Nadia, what I want to understand from you, though, is how you'd respond to the incoming information. Can you tell me how low you think the bar is for a 50 basis point move? What kind of number gets it done? What kind of number doesn't get it done?
You know, we think if we see something that is above 300,000, that it does increase the possibility of a 50 basis points increase. Of course, Chairman Powell gave us a roadmap this week of what would tip the scale for 50 basis points. We already got a pretty hot jobs opening number from JOLTS. We're also going to be watching very closely CPI next week, of course, but we think if you get something above 300,000 and you get the average hourly earnings that are about maybe a half a percentage points, that 50 basis points is more likely. But as you've been noted all morning, I cannot believe that what's happening in the banking sector will not give the Fed pause in this market. Right now, we're looking for a terminal rate, though, of 5.5%.
There we go. Nadia, thank you. Wonderful as always. Nadia Lovell there of UBS Global Wealth Management. Just your guide. Ellen Zetter and Morgan Stanley said 250 might get it done. Of course, all of that depends on what we get from CPI next week. That was a number of about 300,000. Cities down to about 255. They think 255 gets it done. So, Tom, somewhere in between 250,000 and 300K seems to be this ballpark figure that a lot of people think will leave that door open to a 50 basis point move.
I can give you fancy math about the standard error of the non-farm payrolls report. It's out the window. The statistics, the central limit theorem, gone after what we witnessed last month.
What I'm struck by is that everyone's saying something different. Every person who comes on with some measured conviction, measured conviction says, you know, no, the Fed really should go 25. Like, they're not going to go 50. They're going to have some real issues because of the banking crisis. And other people are saying, absolutely not.
This is important because we've got a huge audience. And thank you so much for watching us. You're not Global Wall Street, but you're just curious about this. And their heads are spinning right now over all these events. John Thomas just is out on Twitter with a really kind tweet to us, and it's British. He talks about our cheeky humor.
Oh, he likes that.
What is cheeky humor?
A little bit naughty.
Really?
You know, just a little bit. Not too naughty, just a little bit, the right amount.
It's cheeky humor. Maybe that's why they watch us.
Bear in mind that it's 1 p.m. in London and they drink through this show. Which is a
on
different
Fridays
experience.
particularly.
They're already in the pub.
I did not know this. This is news I need to know. They're drinking in London.
That's why they already enjoy it. They're in the pub now, waiting for payrolls.
Do they have TVs in the pubs there?
Yeah, of course. They tune into us.
In the soccer, and
waiting
then
for payrolls.
For our cheeky
It's a big event in the city. We're in pubs right now across the city of London, the Square Mile.
With Lisa's cheeky humor.
Good afternoon to you all, guys. The payrolls report about 20 minutes away. Randy Krosner, formerly of the Federal Reserve, now of the University of Chicago Booth School, is coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Yes, just less than 20 minutes from now, the February jobs report will be released, and it's likely to help determine what Fed policymakers will do when they meet later this month. It's estimated that the 125,000 jobs last month, a round of hefty to hold interest rates higher for longer. Shares of Silicon Valley Bank have resumed their plunge, losing almost half their value in pre-market trading. That's following yesterday's 60% decline. SVB is a major lender to startups. Peter Thiel's Founders Fund and other venture capitalists have advised portfolio businesses to withdraw their money. President Biden and European Commission leader Ursula von der Leyen are trying to avoid a fight over trade. They meet today at the White House. The U.S. and Europe have clashed over the president's clean technology law. The two leaders are expected to agree to let the European firms benefit from some of the battery subsidies offered only to U.S. producers. And Bitcoin is having its worst week since November. An equity sell-off, fear over higher interest rates, and a U.S. crackdown on crypto combined to hurt investor sentiment. Bitcoin fell below $20,000 today for the first time since January. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio. The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
To go back and justify that we stepped down 75, 50, 25, back up to 50, it kind of puts you in a place that you need to go 50 again in May. They're clearly concerned on the inflation side and that they're not making enough progress on the labor side, but I'm not sure that the noise that we've seen in the data in January justifies reacting to the February data. It's so noisy. We almost have to get to the March data to see what the real trend is.
Well, a little bit more data is coming out in about 14 minutes' time. That was the brilliant Christina Campmany of Invesco weighing in on this jobs report. We're looking for something close to 225. That's the median estimate in our survey. We'll break that down for you in just a moment. But this is what we're looking at right here, right now. SVB, Silicon Valley Bank, is down hard again. It was down hard yesterday by 60%. Right now it's down 67% in the pre-market. We talked a lot about that distinction that's being drawn between some of these small lenders and the large cap, big banks, big integrated players like, say, Bank of America. B of A is only down 0.5% today, so clear lines being drawn here. But then, Tom, what pops up? First Republic, a bank that you know well, was down hard yesterday by, I think, about 16%. Yeah. It's down another 12% right now.
Need to be careful here about the names because state to state, there's so many banks that overlap. This is First Republic Bank /CA, California. This is not the East Coast set of First Republic. I mean, how many First? We probably got 50 First Republic banks that I think of. But yes, this is tarred and feathered by the California experience. And again, it sums up to a set of banks, some directly in trouble and others maybe less challenged.
Food for thought for this Federal Reserve, Tom,
it is.
On top of the payrolls report that we get in about 12 minutes' time.
In this historic moment, we are thrilled to bring you someone unusual for Jobs Day, Randall Krosner of the Booth School, Chicago, former governor of the Federal Reserve System and truly one of our experts on the financial dynamics of our system. Randy, this has to be a different interview today. I really don't care what you think about non-farm payrolls. What I do want you to help our audience with worldwide is that the Fed, out of the Federal Reserve Act of 1913, there is a true dual mandate. the monetary and financial system. Explain how Chairman Powell goes between the monetary challenges of the moment and what we've observed in the last few days, the financial challenges of the moment.
Good, and I'm really glad you drew the distinction, because I think sometimes people muddle the two pieces. And like, if you think back to what happened in February, March of 2020 when COVID first hit, the Fed started buying a lot of assets, and particularly Treasury securities, because there was dysfunction in that market. They then decided to do quantitative easing, but the initial response was really separate from the, and that was a financial response, separate from the longer-term monetary policy response. And so, of course, the Fed is going to try to avoid financial tumult and try to make sure that markets work appropriately. But it's also got to be worried about bringing inflation down.
What do they do this morning to provide comfort to the troubled and less troubled banking system? What is the action the Fed will take, say, over the weekend and into next week?
So obviously the Fed monitors all of this stuff very closely, and they have very good data on the deposit outflows and the amount of capital. And so I'm sure the Fed is totally on top of this and sort of knew what was going on even before it was reported in the in those earnings reports and in some of the public reports. So they're making sure that that banks have access to lending. The central bank can do direct lending to banks and financial services firms. If there's dysfunction in any market, they can purchase assets in those markets, and they can just do that like that, as they did. Well, as we did back when I was at the Fed during the global financial crisis, and as they did very expeditiously when COVID hit. So I'm sure they've got all the pieces in place. They know who is vulnerable, and they'll be there to provide support if there is a problem. Hopefully there won't be, and I think this will be likely, I mean, at least right now, it seems to be fairly isolated, but they'll be ready.
Do you think, Randy, that Fed Chair Jay Powell is doing a good job of communication?
Yes, I think he's been incredibly consistent. I mean, you've heard me on your program for like 8 months now of saying he's had a really consistent message since July. The markets, I think, have not been willing to listen. You know, and as I've described, I think part of that is because there's so many younger participants in the markets. That is, people who haven't been there for 20 or 30 years, like I have, and to know that the Fed at some point will take the punch bowl away when the party really gets going. And they're going to keep at it. And it seems like the market's always surprised when Jay Powell reiterates, well, we're going to keep at this until we bring inflation down. And if inflation is not coming down, we're going to keep at it. He basically said the same message, but the markets got really jittery about that. I think it's been very consistent.
We have heard, though, a slight shift in tone, have we not, about in terms of the balance of risks, and that they're becoming more balanced, less sort of weighted to fighting inflation that seem to have changed of late as we get some revisions that point to a hotter market. I'm curious, from your vantage point, whether your sense of what it means to take away the punch bowl has changed with potentially a higher terminal rate in your imagination than you previously thought.
Well, we've talked before about that they would end in the mid-5s, and I think roughly that's like where they are to be. I mean, Jay wisely has not said a particular number because it depends on the data. I mean, obviously, the jobs market was a lot hotter last month than anyone expected. That's why this number is so highly anticipated. We also have an inflation number that has been gradually coming down, but last month's personal consumption expenditure index ticked up just a little bit. So that Jay has always made it clear he's going to be responding to the data. He's going to be looking at what's going on. Nothing is preset. And if the job market is still at 53-year record low unemployment levels and inflation's not coming down, they're going to keep working at it. As I think I've said this before on your program, until the labor market quits, they're not going to quit.
Randy Krosner is going to stick with us ahead of the payrolls report in about 7 minutes' time. We're looking for about 225. I'm almost laughing.
I know.
I'm biting my tongue.
I know you are.
That is such the establishment view of how the Federal Reserve operates. I get it, and Mike McKee, you're on board, I know, so you can say whatever you like in 2 minutes' time. To say that he's been consistent is ridiculous. And to say that it's the market's fault because the market doesn't understand the Fed is equally as ridiculous. It is the Fed's problem if the market is not hearing the message they want it to hear. And you can't change at Brookings and talk about balanced risk. You can't talk about the disinflationary process starting. You can't talk about adjusting the pace and not expect volatility to come around in financial markets. It's a ridiculous conversation.
Look, this is, and Mike, you can weigh in on this. There is another aspect to this, which is how do you remain consistent in a highly inconsistent universe? And that is sort of the question, right? Do you create this sort of balance of risks and stick with it until you see real pain, rather than wait to sort of change the rhetoric in the face of something that is hopefully the immaculate
Mike, the floor is yours. The floor is yours.
Well, I would go back to what you said earlier on the show. You should treat traders like they are golden retrievers and maybe talk to them.
I was asking to be treated like a golden retriever, just to be clear.
That may be what the Fed needs to do. But at least it's got a point. This has been a very volatile economic data couple of months. And so it is kind of hard to remain consistent. The view has remained consistent, but the language has maybe not, and that has maybe caused some problems. But, the Fed doesn't have to move until March 22nd. So this is really a problem for the markets because they're the ones who want to try to figure out what's going on a day-to-day, minute-to-minute basis.
Randy, I did invoke you by name almost, so you should have the right to respond, sir. You've got about 45 seconds, if that's enough time.
Sure. No, I understand your point of view, and I think it's sort of along the lines of what Mike was saying. I think his approach has been very consistent. They're going to keep at it until inflation comes down. Exactly as Lisa had said, we've had a lot of variable reports. I mean, I think the expectation was that the unemployment rate would start to move up a little bit, the jobs market would weaken. It hasn't. Inflation rate has come down, broadly consistent with the Fed's forecast. It ticked up a little bit. But I think the general message has been quite consistent that if the data are not consistent with the inflation rate coming down, they're going to keep at it. And that's why I'm surprised that the markets are so surprised at that, because I think he's been consistent in that big picture message. The data have been quite variable.
Mike McKee and Randy, you're going to stick with us. Randy, you got the final word there. You'll get the first word coming out of the payrolls report as well in just a moment. TK, it's about 4 or 5 minutes away.
Deutsche Bank Publishing, they suggest it is the most restrictive it's been since the late 1970s.
Equity futures right now,
a few years.
down 0.25% on the S&P 500. Yields lower at the front end by 8 basis points on a 2-year. What a trading range over the last couple of days. Your jobs report in America, up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Around about 20 seconds away from a much-anticipated jobs report. Well, the month of February confirmed the January boom. Going into this data, we're looking for a number in and around 225. That's the median estimate in our survey. Equity futures are negative about 0.2% on the S&P. Bond yields are lower, much lower going into this. We're down 7 basis points on a 2-year to 480. With the jobs data, let's get to Michael McKee. Hey, Mike.
Well, here we go, and it is stronger than expected. Here's Johnny, as it were. We're going to lean to 50, I guess, because it's 311. 311,000 jobs created in the month of February, according to the Bureau of Labor Statistics, and that is... I'm not seeing the revision immediately here, but the change in non-farm payrolls, the net revision is down 34. So we did get a revision to January, and I can pull that number up for you quickly here. December revised down by 21,000. This change for January revised down by 13,000 to only 504,000. So not a major change there, but we do have a much stronger than expected payrolls number. The unemployment rate, though, does bump up to 3.6%. That was unexpected. There was no change priced into the forecast. Average hourly earnings fall. 0.2 they rise during the month, so they fall from a 0.3 rise the month before. On a year-over-year basis, that puts us at 4.6%. You got to calculate base effects in there, but that is smaller than anticipated. The labor force participation rate comes in at 62.5, so that's an increase from 62.4 the month before. The one more thing we got here, the average weekly hours fall from 34.7 to 34.5. So you've got some signs of slowing in here, and you've got some signs of increase. I'll let you see what the signs in the bond market are being read at, and I'll get you some numbers.
This is super difficult to read. So I think at the moment, and I stress for the moment, we're not trading on that headline number. We're trading on a softer wages print. We're trading on a higher unemployment, increase in participation, a reduction in hours worked as well. And we've got a big rally in the bond market again. So yesterday, the 2-year yield was down 20 basis points. It's down another 18. Think about where we've been this week. 5.08% 2 days ago on a 2-year, and right now, 4.69. That is a big change. So yields in aggressively in the bond market. Equities higher by about 1/3 on the S&P. And as I say, and I'll repeat it, the first move, not always the right move, but that's the early interpretation of this incoming information, Tom.
There's no question about that. As Mike digests the data, I'm just going to say that as I look at the green and the red blinking on the terminal, John, it's simple. This is a disinflationary pulse and sets us up for what if we see on Tuesday some form of disinflationary trend.
I reject any interpretation of this initial read whatsoever in terms of the longer-term expectation. I completely reject that.
Because they're going to come to me and say, what do you think?
Well, I mean, looking at this. It makes no sense. We had person after person come on this show and say they're going to be forced to go 50 basis points if you get above that 250 number. We got 311. We did not get a significant downward revision to the prior month's employment report. By all levels, this is a very strong labor market that still gets revised to the upside. So yes, the Fed can say whatever they want, but the bottom line is, based on what Fed Chair Jay Powell's laid out for himself, it's going to be really hard to
let me give you a quick possibility here. When you look at the jobs that were created, construction jobs were on the month up by 24,000, a bit of a surprise, but manufacturing jobs down 4,000. That's the first loss in a while, and it's also a suggestion that people who had higher paying jobs were struck from payrolls. Leisure and hospitality is the biggest job gainer, 105,000, and that suggests that we're still trying to fill jobs that were open, but they are lower paying jobs. And so maybe we're not seeing as much wage pressure as we had seen. And my initial reaction when I saw the number was, here we get the no landing guys coming back again. You know, what if we have?
So that's your interpretation. Seriously,
no, I'm not going to. I'm going to be with Lisa on this. It's a little hard to interpret, and I don't want to give you a quick answer, but I suspect people will say, well, maybe we don't have to have a hard landing, and we can bring inflation.
I value revised data as we get to our esteemed guest, John, and it's real simple. There's over 1 million jobs in the last 90 days. The 3-month moving average with revisions is 351,000. There was a point where Randall Krosner ripped the chalk out of my hand and said, Tom, the demographics say we could go under 100,000 as normal. We are miles away from a normal job economy.
It's really difficult to stay open-minded after the jobs report, especially in the first few minutes, but given experience, sometimes the first move is not the right move, but I will keep stressing that's the early interpretation of the incoming information so far, seemed to de-emphasize the headline number, which is a clear beat and in line with what people said would lead to the 50 basis point door remaining open, but the attention is firmly elsewhere at the moment. A lift in unemployment, an increase in participation, a reduction in hours work, and a disappointed in wage growth. Disappointment, downside surprise there month on month. So equities are higher, and I'll keep saying for now until I go home at about 10 a.m. this morning. I'll keep saying for now because I have no idea what this is going to be like at the close. And in the bond market, yields are aggressively lower at the front end by about 17 or 18 basis points on a 2-year to 469. So what's that, about 40 basis points south of where we were 2 days ago on a 2-year yield. Tom, I stressed, you know, it's this together with next week, the 14th, the CPI print still to come.
Well, we're going to continue. Mike, do you have any jewels you want to share with us quickly before we go to Randall Krosner?
Well, I just would point out that in the unemployment rise, we did see a big rise in unemployment in the household survey, 5,936,000. That's an increase of 242,000. The level change for employment was an increase of 177,000. So more people got jobs, but more people report losing jobs.
Right.
Almost no change in the labor force, so that's not really, well, it's 419,000, but that's down from 866 the month before.
John, did Silicon Valley Bank trade off the jobs report?
SVB still down and down hard, Tom, by 62%.
The headline
any
says,
relief at all.
Trading halted with news pending. Mike McKeel continued to digest this, and through the 9 o'clock hour, who do you have on 9 o'clock? Rick Reeder's going to be there?
Do you want the tease? I'll do the promo now if you want.
No, seriously.
Next hour, Rick Reeder of BlackRock.
On 6%.
Mohammed Al-Arian is coming up as well. We'll catch up with Tiffany Wilding of
Non-transitory. He's
PIMCO.
buried in snowdrifts in
P. Jim's
Cambridge.
Mike Collins. And you know who's getting a big wage increase? We'll catch up with the Labour Secretary as well a little bit later.
This is his final interview? Be nice.
He's doing okay.
Nice.
We're having a hard time. Wage growth and all of the above, Mike.
They get a penalty 2 minutes cross-checking.
We're having a hard time deciding what the Fed is going to do. The 50 basis point move is bouncing around the 50% mark right now, 53%.
Can I say this before I run? If you get a hot CPI print next week on March 14th, everything else in this report gets de-emphasized.
Yes.
So the stuff that we're trading on now, which is softer wage growth, will get completely ignored.
If you get a disinflationary vector?
If you get a hotter CPI print next week, because people will just put the hotter CPI print together with the big headline.
What does a modest disinflationary vector mean off Tuesday? To me, it's massive
That would be
news.
super encouraging, Tom, together with the wage growth participation figures. That would be, that would lead, that would give the Fed an excuse to back away from the 50 talk for sure.
Well, futures up 9 right now. The VIX 22.91. We continue as we do with the former governor of the Federal Reserve System, Randall Krosner. Before we spoke about the financial side, now Krosner on our monetary system. Randy, in this milieu, can you use theory? Can you use anything that was invented at Yale years ago or at London School of Economics? The theories that matter, are they valid and beneficial at this time?
Even some of them from University of Chicago too. Yeah, no, I think it gives us a broad framework for thinking through these issues. But exactly as you were discussing, these data are not clear. And as we were talking about with Lisa before, the data have been quite volatile and sometimes difficult to interpret before. And gosh, this report is not completely consistent. Although I think Mike may have hit on exactly one of the issues in the so-called composition effect. If you're growing a lot of jobs in the lower wage part, like hospitality, but losing them in the higher wage part, like manufacturing, that could lead to that number coming down, that average hourly wage, but wages may still be going up because in each of those individual categories, wages may be up. So we've got to get more data on that. So, yes.
To speak to the Chicago theory, Lisa's been beating me to death with long and variable lags. Does that math work now? Is it useful?
Oh, Milton Friedman articulated that like 70 years ago, and I think we're still seeing that. We certainly have seen some lags. We've certainly seen some hit in housing market and in certain sectors, but not in all the sectors. And obviously there are lags, and we'll see when the tightening of monetary policy really hits. It may not come for a few more months.
Randy, we're seeing in markets people back away from the likelihood of a 50 basis point rate hike at the meeting of the Federal Reserve later this month. Do you think that that's valid, given the guidance, given the strength of the labor market, given the lack of significant downside revisions to what we saw in January?
So we still have a very strong labor market. There's no way around that, and especially at this point in, after the Fed has been hiking for a full year, those lags might be long and variable, but this is a bit surprising. See so little impact, and so I don't think the Fed has made their decision. I think exactly as John said, as well as Tom, the inflation report is going to be very important because it's really, this is one input, a key input into what inflation is going to be, and that's ultimately what the Fed cares about, is bringing inflation down. If we do see inflation starting to come down, some around the table may feel more comfortable to just say, well, let's stick with 25. But if they don't see signs of it coming down, and you just look at this labor market being pretty hot, I think a number of people will want to push for 50.
It's early days yet in terms of the market reaction, but the knee-jerk reaction seems to emphasize the decline in average hourly earnings and the tick up in the unemployment rate as why perhaps the Fed wouldn't have to go quite as far as previously believed. Do you think that these are significant things, that these are developments that highlight softening around the edges that will show up later on?
Well, as I was saying, that the reduction in the average hourly earnings may just be a composition effect, and so I think it's hard to interpret any one report in too much detail, and really say, well, the Fed's going to change because of it. I think looking over the last 3 months, we still see a very strong labor market. I think that's what the context in which Jay Powell gave his testimony. I think the labor market is still pretty strong. It doesn't seem to be strengthening, but if it were, then I think it would be very clear it'd have to be 50. Now I think it's reasonable that the market say it's an even bet, but I think a lot will be determined by the inflation number on Tuesday.
Professor Krosner, thank you so much for joining us today from Madrid. Obviously, Randy Krosner with the Fed, and also with the University of Chicago Booth School as well. We now turn to bond market reaction. He's aged overnight. Jeffrey Rosenberg joins us now, portfolio manager of Systematic Multi-Strategy Fund at BlackRock. Jeff, open question. What's the multi-strategy right now?
The multi-strategy is defensive here, Tom. I mean, there's a lot of focus on 25 versus 50, but I think the real message of the week was that Powell reemphasized financial conditions need to stay tight for transmission of monetary policy to work. And the thing that we lost sight of here is how is monetary policy supposed to actually bring down inflation? It functions mainly through financial conditions tightening. And when you look at where we were at the end of January, financial conditions were basically back to where they were before the tightening even began, effectively unwinding all of the tightening in policy. So the pushback here is coming from the data differently. And, we can parse today's payroll report. I would emphasize the earlier conversation. AHE is the worst measure of real-time or near-term measures of wage growth because of the compositional effects. But beyond the noise of the data, the issue is that financial conditions aren't tightening enough. And Powell pushed back this week, and that means that it raises the prospects that they have to do more. That's the 50-25 debate, but it's really the terminal debate that is important here, and that they're much more willing to push the risk up of a recession.
Jeff Rosenberg, you're going to take in the various narratives and you're going to filter them through a Carnegie Mellon education, which is hugely probabilistically determined. Fine. Can you state that we are in a disinflationary trend now? What is the probability that the vector coming off of this report and coming off Tuesday will signal disinflation?
Well, I think what we had is finally the realization of peak inflation. And remember, that was the big debate for a while was, the expectation that we'd hit peak inflation would come down. And it just kept getting disappointed. Last November, we hit the peak inflation and everybody got very excited by 3 months in a row of very good inflation numbers that showed a decline. But decline to what level? Right, the Fed is talking about getting back to the pre-COVID 2%, and nothing in the data that we're seeing in terms of the persistent measures of inflation, which is really that core services, ex-housing services, which is really about labor and markets and wage inflation. Nothing has really said that the Fed's tightening to date has done the work that's necessary to bring that back to 2% target to have that be accomplished.
Jeff, you were talking about the financial market conditions and how that's really important for the transmission of Fed policy. I'm looking now at the terminal rate being priced in, a 5.3%, down from 5.6% earlier this week. Do you think that this is an accurate response to the report that we just got?
Well, I think the market is being whipsawed a lot around positioning and technicals around 25 versus 50. So you have to be careful about over-interpreting kind of the longer run fundamental interpretation from today's news. And as John was saying earlier, come Tuesday with a hot CPI report, all of this is going to get sort of thrown out and reinterpreted. I think the broader message of the raising of the terminal rate is the right response to what Powell said earlier this week, that we need to do more. And that's really the broader message of the failure of the core measures, the labor market measures, the core ex-housing, ex-services measures of inflation to really respond to what is a very significant amount of tightening to date. So it's higher for longer. And you got to price out that expectation that the Fed's going to turn around very quickly and be able to cut interest rates as well.
My head's spinning, Jeff. I got to be honest. Everyone said something slightly different. Everybody has a different base expectation of what the Fed's parameters are to hike rates.
It's like the Bravo dining room table.
I mean, yes, actually, that's completely accurate. I'm looking at this. Is there any certainty in your investment thesis that you have continued to drive home, that you continue to have conviction in, Jeff?
Well, you're going to hate this answer. The only certainty is the uncertainty.
Oh, dear Lord.
He learned that from Alan Meltzer. That's Alan Meltzer 101.
Come on.
Continue.
I knew you weren't going to like that one, but it's about recognizing that there is a lack of ability of forecasting and inflation. That's really the issue here. Is that the market consensus is pretty confident, or was pretty confident in a steady return to 2%. And the history of the accuracy of forecasting inflation here just doesn't bear out that degree of confidence. And so it's really about recognizing what we know and what we don't know relative to what's priced into the market. And there you certainly saw a lot of skew to the downside, and that downside has been playing out, over the course of February, the first part of March here.
Jeff Rosenberg, always thank you. He is with BlackRock. The VIX in nicely, almost a stick, 21.7 off, 7.9 off the angst yesterday. Nasdaq up 0.8%. Michael McKee quickly here with an observation of 47 pages of BLS data.
Well, a couple of quick things. One here is that the number of retail jobs increased by 50,000. Most of those at department stores. So that gives you some indication that perhaps retail sales have not pulled back or did not pull back a lot in February. Also, retail employees got the biggest raises, up 1.1%. We talked about leisure and hospitality. They were just up 0.3%. And manufacturing was flat. So the story kind of holds that we hired people in lower wage occupations and not in higher wage occupations. The other observation I would make is we have now dropped to a 34% chance of a 50 basis point move in the market. So people rapidly pricing that out.
Let us continue now. We will with Ira Jersey. He has been known for years on Wall Street for short-term rate analysis. That is really important here as we see LIBOR 3 months and the SOFR and the rest of it go out near 5%. He is our chief U.S. rate strategist for Bloomberg Intelligence. Ira, I keep asking this, but do you see a disinflationary trend in place, even if it's ever so shallow?
Well, there is. You know, we had that one little blip in a lot of the data in January, which gives us a lot of pause. But we have to keep in mind it is only one data point, and we have to look at all of the other data in totality. So, you know, today's data I don't think really moves the needle that much for the Fed. You know, maybe they go 25, but we still don't know where that terminal rate's necessarily going to be. Because if the data doesn't slow down and we still see some inflationary pressures, then the Fed is going to hike more than we originally thought.
You're not on a trading desk. You used to be. Is there opportunity, Ira Jersey, in these gyrations in spread and also just simply nominal levels?
Well, there is, and you know, trading desks generally like volatility as long as it's kind of predictable volatility. And I think some of the, you know, we came in this morning and we already saw that the Treasury market had rallied quite a lot with two-year yields better by 15 basis points. And you know, that's an environment where if you're a trader and you had a position overnight, you're either loving it or hating it. And today's numbers this morning, you know, we saw some volatility around the knee-jerk reaction. But yeah, I'm sure that there is some trading opportunity, and people can take advantage of that in the very short term. You know, investors, on the other hand, people who have a longer time horizon, you know, 3 months to a year, for example, which is kind of the sweet spot for where I try to look, is you know, that's a little bit it's less obvious what this means or what this one data point is going to mean for that longer term trends in yield.
Let's stick on the immediate reaction for a minute. One Twitter user who calls themselves Exhausted Bear writes, if I knew the print ahead of time, I still would have lost money, because that is how sort of strange the trading activity was to some who just were looking at the headline number and what everybody was saying ahead of it, what the bar would be to raise 50 basis points at the next meeting. I'm just curious, from your vantage point, all things being equal, does this, in a report that we just got, raise the terminal rate that you expect the Fed to get to?
It doesn't. It actually probably lowers it or decreases the chance of a 6% terminal rate at this point. And not so much because of that headline 300,000-ish payrolls number, which is a solid number for sure. But when you look at the totality of the data, and we have to remember, like you know, the knee-jerk reaction is often that red headline on the Bloomberg terminal where payrolls are. And then when you look at the wage data, you look at the hours work data, you then look at the household survey and realize there were 242,000 more unemployed people this year or in February than there were the month before, right? So when you look at the totality of the data, it is much more mixed. And that's one of the reasons why I think you got this big knee-jerk reaction, and then things settled back down to where we were prior to the number coming out.
Ira Jersey, thank you so much. To have Jeff Rosenberg and Ira Jersey back-to-back speaks lots to our booking team and talking on bonds. Here's how crazy it is, and I usually don't admit this, but with McKee next to me and all we've been through over the years, it's so crazy right now, folks, that often, Mike, I look at the top of a research note to see when it was written and when it was released. That's how quickly the gyrations are occurring. And I do this with Edward Harrison of MLive, wonderful and acute work on the markets and linking into economics. Ed Harrison of Bloomberg joins us right now. Ed, I cheated. I looked at your brilliant note pushing back from no 50 beep rise, and you wrote it a good number of hours ago. This jobs report confirmed your idea that we won't be so abrupt.
Yeah, I think that the 311 number, I have to agree with Ira. It doesn't tell the full story. The real story is that we know that there were a lot of jobs that were being lost. We know that from Bloomberg Economics that it takes 60 to 90 days before those people to start filing for claims. So we're kind of seeing that from the household survey with a 3.6% unemployment. We're seeing at the same time more people entering the labor force, which should help keep wage pressure down. All of that suggests that the Fed had wanted to go maybe to 550, 575 at the most. And I think that this is in line with that.
You were weaned at Dartmouth within the Blanchflower bubble, and David Blanchflower has been world acclaimed for questioning labor statistics. He thinks it's a much more fragile labor economy than some of the Valley Bank halted for news. It's called the Brammo halt.
Yeah, we'll keep that in check, and we'll keep you updated on that. But Ed, I am wondering about the room for nuance at a time of otherwise hot labor market prints. We're parsing through the details of a report, and perhaps rightly so because of those long and variable lags. At the same time that revisions have been to the upside, not necessarily January's, but otherwise for a number of months. Do you think that there is enough room for nuance, Ed, at a time when otherwise, as you point out, this market has remained, perhaps, or this economy has remained more resilient than the Fed expected?
Yeah, I think that the reason that we have nuance particularly is that the Fed stepped down to 25 basis points. And you have to ask yourself, why did they do that? The reason they did that is because they thought they were nearing the end. The data that we got in January, which was, some people think, an aberration, caused them to rethink that the markets rethought the data more than the Fed rethought it. And so I think that the markets are now moving back to where the Fed likely is, and we'll just have to see what the CPI data say. But my view is that the Fed wants to make it, a few 25 basis point hikes at the most, and then they want to hold, and that's it. That's the path that they want to be on.
Just as we get some of this banking news, and as we see some moves not just in SVB, but also in First Capital as well as Zions Bank, I'm wondering from your vantage point, what you're seeing with respect to not necessarily credit markets that are public, but private credit markets. Is there concern there? Is there the feeling that there's going to be forced sales that put more pressure on valuations?
I think that this is a problem that SVP is bringing up because they have a big book of MBS, CMBS, and what we know is that the occupancy rates for CMBS in particular are lower, and we've already seen some handing in the keys from tenants. That is that they decided not to pay their mortgage. This is the sort of thing that is going to be a problem, not just for banks, but for the wider financial community, because in private markets, this was a place where people were trying to pick up yield, and I think that it could be a problem over the next 2 or 3 years.
Edward Harrison, thank you so much, with Bloomberg here on the historic moment, linking markets into our economics. Lisa, I really don't know where to begin. I'm going to go to Mike Mayo earlier today on banking, and something he said in a quick of a sentence, which we really didn't discuss. He's doing what I'm doing, watching commercial real estate out front. And you've got a massive focus on this within fixed income. But I'm trying to find, it's like the butterflies in Silicon Valley, and what do they mean flapping for banking on the East Coast? That's sort of the arch debate. And I'm just wondering, given the swirl of everything we're in right now, what's the tea leaf I should be watching? And I'm guessing it's commercial real estate.
A lot of people have been watching commercial real estate. If you take a look at valuations, I think, though, that this is a big concern, considering not just property values pinned to mortgage rates, but also just the shift to working from home, from office space, and what that read-through could look like. That said, I think that you raise a great point. What kinds of financial read-throughs have we not seen yet that might give the Fed the opportunity to take advantage of the market response to this report, whether right, whether wrong, the market's response as an excuse to go just 25 basis points? Are they getting a green light to do that without causing any kind of disruption?
The other thing, Edward Harrison was very good on this about GDP coming down. We didn't even mention it today. We may get a Brent crude of 79. I've got Brent now at 82.04, and it made a dash for 81.80 earlier this morning in the angst. that shows you that global slowdown, even with what seems to be a better China. And I'm wondering here, the GDP calls we may see off the inflation report.
I'm so confused. I'll be honest.
Well,
I'm trying to put this together in some sort of cohesive narrative. I can't. I'm not going to try. I think that what we're seeing right now is, as Randy Krasner said, a hot labor market. We are seeing signs of softening. It is backward looking, and we're seeing real moving, really serious signs that there are just pockets of distress that are forming.
It's okay to be confused here. I really can't convey that enough, folks. The ambiguities of the moment, extraordinary. Stay with us today on Bloomberg Television and Bloomberg Radio. Good morning.
Nothing to see here. Put on the golf or something. What a morning. Live from New York City this morning. Good morning, good morning. Equity futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, payrolls data in America coming in hot, leaving the door open to a 50 basis point rate hike, even as Silicon Valley Bank races to prevent a bank run. We begin with the big issue. It's jobs day in America.
We obviously get payrolls.
Non-farm payrolls.
50 basis points is very much on the table.
They're back to the pace being a tool. Chair Powell opened the door. They de-emphasized the pace, and then now the pace has come back as a tool they're using to manage inflation.
The Fed tightening has consequences. The labor market is still strong. Inflation is sticky. We don't think hiring can defy the gravity of Fed tightening forever.
There is clear labor hoarding going on.
It's taking longer for those effects to be felt.
They are not willing to let the lags play out.
We are now hanging on to every data print.
This is a data-dependent Fed.
I don't think the Fed has made their decision.
They're moving data point by data point.
The inflation report is going to be very important.
We've got so much to work through the next 60 minutes. I'm pleased to say that we kick it off with two all-stars, Mohammed Al-Arian of Queen's College, Cambridge, and BlackRock's Rick Reeder, with one eye on SVP, down more than 60% in the pre-market, halted with news pending. When we get that news, I'll bring it to you. Mohammed, first to you. Your response to that jobs data about 31 minutes ago.
Really tricky, John, and it highlights the fluidity, the unusual uncertainty, not just about economics and policy, but also what's being introduced by policy communication. This is a very, very difficult environment now. And I feel for Rick and others in the investment management industry that have to make decisions based on this.
Well, Rick, you get some sympathy this morning. I'm sure that's welcomed. What do you make of it?
Deservedly so. Listen, I think that, the number is strong. Listen, there's some governors on this. You take some comfort with the average hourly earnings coming down. We're coming off the boil in terms of hiring. But gosh, you look at these component parts, and we talked about it last month on the show. You look at leisure, hospitality, healthcare, education. You're still not where you need to get to in terms of fulfilling the job requirements or the number of people for those sectors. So you've got some durability to this employment strength, and it came through again this month. So like Mohammed said, you've got what is a solid employment report. You've got solid hiring in this country, and it makes the Fed's job tough.
In the immediate aftermath of that jobs report, Rick, it appears that we're trading on everything but the headline number. We're trading on a reduction in hours worked, an increase in the participation rate, wages coming in softer, unemployment up to 3.6%. Would you say that's the correct interpretation, the right move?
So quite frankly, I think there's some of that. I think it's more of, you got a little bit of whiff of financial instability in the last 24 hours. That's what's buoyed a lot of, particularly the front end of the yield curve, is people saying, gosh, long and variable lag may just have sped up a bit. You're seeing that play out. This is a pretty unique situation on the West Coast. That being said, it's illustrative of, you've got to think through, how do you quickly slow down things like commercial real estate, residential real estate, et cetera? What's the impact on the system? I think that's a bigger factor than, quite frankly, what is a strong, albeit slowing in some areas, payroll report.
Mohammed, January 26th, you wrote for Bloomberg Opinion why the Fed should raise rates 50 basis points. They didn't. The Fed chair earlier this week opened the door to a 50 basis point move. And to Rick's point, Mohammed, we've now introduced some financial stability risk and yields have backed away big time. So where are you now?
So, John, you know my view. Because the Fed has been consistently late, the probability of a market accident and the probability of the Fed having to hike into a slowing economy and a recession is uncomfortably high. That is the reality. That is what happens when you fall so far behind. Rick is absolutely right. I mean, the marketplace is keeping an eye on two mini market accidents and saying, you know what, the Fed won't have the guts to do what it needs to do for inflation. That is what you're seeing playing out, because parts of this employment report suggest 25, parts suggest 50, and when you've got that balance, you then look for a tiebreaker, and the immediate tiebreaker is what's happening in selected banks. Now, it's absurd, John, for me to say, of course, next week's CPI will matter a great deal, and that will be another tiebreaker. And it's absurd because we have become excessively data dependent. You and I have talked about this. There is no strategic or structural underpinning to monetary policy right now. So you've got a yield curve, the 2-year points, which is going all over the place. You've got expectations for policy going all over the place. And that is not how you conduct either a very important segment of the marketplace or policy.
Well, let's put some numbers on that phrase, all over the place. 2 days ago, the 2-year yield was 5.08%, and right now it's 4.73. That has truly been all over the place. Now, Mohammed, I think we're all really wary, super wary this morning about extrapolating out unique problems, unique situations right the way through the financial system. But are we seeing real signs of financial stability risk emerging?
Let me tell you what we're seeing. We're seeing that the correct statement that the banking system is sound as a whole doesn't mean that every bank is strong. We are seeing the correct statement that if you're a bank sensitive to both, and I want to stress both interest rate risk and credit risk, then you have a more difficult outlook. And then we're seeing the correct statement that plays out in specific areas, and I'm really glad Rick rightly pointed to others. We've had a tremendous buildup of leverage in this protracted period of zero interest rates and liquidity injections, and keep an eye on these areas where you've had significant leverage build up.
So SVB is the bank in the news, Silicon Valley Bank. It was down more than 60%. It was halted pending news, and I can tell you that CNBC has reported that financial attempts to raise capital have failed. They're in talks to sell itself. And Rick, I can appreciate that maybe you can't comment directly on this single name, but I'd love your thoughts on what's been unfolding over the last 24 hours.
Yeah, I mean, so listen, we spent early this morning, we were working through all of these, and yeah, obviously this situation and the tangential ones. And listen, I mean, I think there's some unique characteristics to this situation, which you've well chronicled. You know, I think what you got to look at, you know, all of these things have complexities today. I mean, commercial real estate is a tricky dynamic because, quite frankly, parts of it, multifamily is in pretty good shape, hotel and leisure is pretty good shape, office is difficult, Class B office is really difficult. So, you know, you've got to, we're now entering a place where when you lift rates so quickly and the leverage has built in the system, you've got to look at where the problems are. In some places, you know, where liquidity is actually in really good shape and you're in the right sectors, albeit you may have some leverage on, then you could work your way through it. But, you know, this is, you know, we're going to enter an environment, and I think when you think about asset allocation, you think about what you're doing as an investor, you got to get deeper today. I mean, you know, to make some top-line perspectives on some things, you've got to get deeper. And I think, quite frankly, for the near term, you know, you got to be a bit careful. You know, we built some cash into the portfolios because you got to be a bit careful around some of this nuance and the complexity of some of these dynamics playing out, like Mohammed was talking about.
Rick, you and I have watched that evolution of that cash allocation of yours over the last 6 months or so, and every month you've given us an update. And I wonder if there's anything you're avoiding right now, choosing to avoid, de-risking from, and has that cash pile increased in the last month or so?
Yeah, I know it has. You know, it's funny. We talked about it last month. that, you had a window where it looked like inflation was coming down. We're pretty confident the economy's in good shape. We don't think, the discussion of recession, deep recession was a really durable one. But the thing that changed in the last month was, gosh, the pervasive nature of inflation. You look at these core PCE numbers, the CPI, as Mohammed said, we got to focus on next week's data. And by the way, not just in the U.S., you look at European data, that changed the paradigm quite a bit. And all of a sudden, not only is inflation not coming down, in some places it's accelerating. So yes, we built a decent amount of cash. And quite frankly, some of the asset classes, if the Fed has to go further, if they have to go to 6, you do create a slower economy. You do create potential recession in 2024. High yield, not very interesting. Gosh, you could buy things like commercial paper at 5.5%, 5.75%. I'm looking at double B high yield at 7.25%. Why? You don't need to take the risk. So yes, we've reduced some of that spread risk and said, you know what, I'd rather sit in commercial paper, treasury bills, and you're getting paid for sitting in the front end in a way we haven't gotten paid in years.
Rick, I saw you float the idea of 6 a little bit earlier on this week, and Mohammed, maybe we should take a step back and really think this through. Can you imagine a situation where we get a hot CPI print next week, put that together with a headline beat on payrolls, and this Federal Reserve on the data alone has to talk about increasing, going back to 50 basis points again, at a time when you're seeing this kind of news in a financial system? Now, Mohammed, I get it, you get it, it's a unique situation. It's a very unique situation to this particular bank with a concentrated issue, with a lack of diversification around its funding. I think we all understand that. But when you see headlines like this, reports that this bank is in talks to sell itself, its attempts to raise capital have failed, down 60% yesterday, down 60% again this morning before it was halted with news pending. Mohammed, how does the Federal Reserve sit around the table and have a real conversation about reintroducing 50 basis point rate hikes with that as the backdrop?
So let me give you 2 economic arguments for why they should do 50, and then the qualifier. The first one, John, is very simple, is inflation has got stickier. It has gotten to the service sector. The longer they wait, the more they're going to have to do, the higher the peak rate. And you've heard Rick mention 6%. And you may end up with even more financial accidents. So that's the first economic argument for why you do 50 now, and it's why you should have done 50 last time, it's why you should have started earlier. Don't compound the mistake. The second argument is fundamentally understanding that you do not use one tool to meet 2 competing objectives. And if you use the monetary policy tool to try and meet 2 competing objectives, which is inflation fighting on the one hand and bailing out the banking system, which doesn't need bailout, by the way. A firm needs to get its act together, but not the whole banking system. But if you do that, you will fall in the muddled middle. So the economic answer is go for 50 and use other tools. What this Fed will do, I don't know, John. This Fed has surprised me so many times that the qualifier is that it's very hard to predict this Fed because they flip-flop all the time.
Mike McKee's our Fed whisperer. Mohammed, you know that. Mike McKee joined us now. Mike, you and I thought we'd be talking exclusively about the jobs report this time yesterday, and there's an extra wrinkle in the story now.
Yeah, there is an extra wrinkle in the story, and that's the banking system and the Fed's responsibilities there. But I don't think it's going to really affect their view of what they need to do on March 22nd, unless this gets to be something systemic beyond Silicon Valley. We do have, though, some news for them in terms of what they want to do for the economy, because we do have a strong economy still, strong labor market, 311,000 jobs created during the month. The January numbers revised down only to 504,000, so we're still seeing a lot of hiring out there. The unemployment rate, though, ticks up, and the participation rate tick up. Had somebody write in and ask why that is. Well, basically, more people looking for jobs, so more of them are out of work at the moment, and that pushes unemployment up. Average hourly earnings is the real story in terms of the Fed, because we've got an 0.2% rise, which is lower than anticipated and lower than last month, and the base effect 4.6%. The Fed will look beyond that, and they'll look at the 0.2, because if you look at what the annualized rates are, the 3-month annualized rate in February is 3.6%. That's the lowest since March of 2021. And here's the reason why. We're having a composition effect. Leisure and hospitality, the biggest gainer for jobs. Food services, 69,000 jobs. Those are low-paid jobs, and we're seeing also retail jobs tick up a lot. They're in the lower-paid sectors. Healthcare and social services also in the lower-paid sectors. Manufacturing is the highest-paid sector, basically, outside of finance, and it lost 4,000 jobs. So the people who are coming into the labor force are filling the jobs. Rick brought this up earlier about jobs that are still open in sectors that need to be filled, and we're seeing basically that happen. The lower-paid sectors are getting the jobs they need. Manufacturing overstaffed if the economy is slowing, and so that is maybe going to bring down some inflation, and it has certainly brought down the bets on what the Fed is going to do. The bet on a 50 basis point move in March soared to 70% after Jay Powell testified on Tuesday and Wednesday. It's now down to basically 40%.
There we go.
As people price this out. Now, the whole report is basically the John Farrow full employment report, because he's going to be here every day. You got to watch, because we got CPI next week, so we're going to debate whether the Fed is done or not.
Well, I think we can also thank the ticker SIVB for some of that reduction as well in the last 24 hours. Mike McKee, thank you for that. Off the back of all of this, we're down about 15 basis points on a 2-year to 471. It's not just the data, it's the risk aversion as well. We were as high as 5.08% at the front end of the curve just 2 days ago. Big reduction in that level. Equity futures really aren't doing much. We're down about 0.1% going into this opening bell in about 15 minutes' time. Mohammed, I remember when you and I were going back and forth on this maybe 3, 4, 5 months ago. I think it was late September. We talked about the trilemma of a policymaker, and we were looking to the UK and the experience the Bank of England was going through. Do you get the sense that's an appetizer of things to come?
A small appetizer. It's, the policy mistake is not as pronounced as what the UK tried to do, and the LDI trade is very different from what we're seeing here in terms of SVP, but it just highlights that you can't ignore the implications for a system that got used to abundant liquidity and zero rates. You just can't ignore it. Again, it doesn't mean you make monetary policy hostage to it. There are other tools that you should be using actively. And it highlights once again that you need a better understanding, not just of the smaller banks as well as the bigger banks, but also of the non-bank sector.
Rick, what's your take on this?
So, listen, I think there are a bunch of complexities around this. I think the central banks today, I mean, by the way, you throw out some of the other issues, as you keep raising rate, you not only create issues in terms of the financial system, you think about how the government, what fiscal policy can be going forward. We were doing a bunch of work on CBO estimates of how much the debt burden is going to be, the cost of servicing the debt, what it does to discretionary spending going forward. I mean, all these things are big, complex considerations. I agree. I think at the end of the day, I would go 50 as well. My guess is the markets are right, and the odds are probably not, especially given the news we just got. But like Mohammed said, there are other tools. You need to make sure that the liquidity in the system is ample. And but listen, their primary objective today is inflation is running hot, and the reason why I threw out there's a reasonable chance they go to 6 is exactly that. I mean, inflation is hotter, not just in the U.S., and they have to react to that.
Rick, this phrase "sufficiently restrictive," we throw it around a lot. What is sufficiently restrictive?
So, I often go back and think about this idea that you don't really know until you see it play out. And this is part of the idea around why I think the Fed will err on the side of doing 25s for longer, is you want to start to see how that long and variable lag works, how you're starting to see the dynamics play out. My sense is that you're getting to levels today, and it certainly played out in the last couple of days in some specific places, that you are going to see the slowdown. But the thing that is fascinating about this economy, it's different than anything we saw 70s, 80s, when people look at those analogs, is you have an economy that's partially interest rate sensitive, and you look at, obviously, real estate, vehicle finance, durable goods finance. That has to be financed, but you have a big part of the economy. Where is CapEx today? It's not in structures. It's not in machines. It's in things like technology, AI development. Those aren't really interest rate sensitive. So this is part of why it's so hard to figure out what is the equilibrium rate today when you've got a very different economy.
Equal parts attention right now on the jobs report from about 50 minutes ago. And Silicon Valley Bank, SVB Bank, of course, the CEO was reportedly telling clients yesterday to stay calm. Reports suggesting that some of those clients were doing anything but. This morning, the stock was down by more than 60% again. Then it was halted, news pending. Some news, some reports. One report coming in the last hour from CNBC, the capital raise efforts have failed. They're in talks for a sale. Kelly Lyons has more on this story down in D.C. Hey, Kaylee.
Hey, John, this has escalated so rapidly. Now it looks like they're trying to prevent a total bank run and an absolute exodus of client assets and deposits, but of course we're seeing the exodus in the shares, and it really is, to the conversation you three were just having, a question now of, is this an isolated incident of a bank that was heavily exposed to high-risk clients being tech startups, or is this a signal of something more systemic happening? Considering banks across the board all will have some exposure here to longer duration assets, government treasuries, which of course we have gone down in value as the Fed has hiked rates. There is reason, though, to highlight how SVB is unique. When you actually take a look at their investment portfolio, it's swelled to 57% of its total assets. Compare that to the other 74 competitors in major U.S. banks. None of them had higher than 42%. So that is one reason to maybe view this differently, but that does not necessarily mean the market is viewing this differently, because you are seeing the bleed through to other regional banks in pre-market trading. First Republic, of course, also heavily exposed to that tech client base after a 16.5% loss yesterday. It's down another near 25% right now in early trading. You have Zion, Signature, each down by double digits as well. And if you just take a look at the longer term, we know regional banks have been under more pressure than some of those larger, more diversified peers. Over the last year, the regional banks ETF down about a quarter compared to the broader financial select sector spider down just 8.5%. Another way to look at the pressure is to look at the options activity. And when you take a look at open put interest on the regional banks, you can see that's at a record, a big spike on the white line. And again, SVB, the specific bank we are talking about today, is still halted with news pending. John, at the time of the halt, was down another 63% in pre-market trading.
Brutal stuff. Yesterday it was brutal. This morning it was brutal. Katie, thank you. And when we get that news, that update, I'll bring it to you. Overwhelmingly, the analyst community pretty much on the same page. Matt Mayo of Wells Fargo, Mike Mayo, saying this: SIVP is a worst case. The core issue at SIVB is a lack of funding diversification. They said most SVB deposits are from VC, which has its issues. We know that. To us, the larger bank, the more diversified the funding. You'll just hear that repeatedly. Heard a similar story from Betsy Grasick over at Morgan Stanley. We want to be very clear here. We do not believe there is a liquidity crunch facing the banking industry. The headwind for the banking industry is the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue, and EPS. As I've repeated all morning, particularly over the last 20 minutes, that stock is halted, news pending. It's down just before that by 62, 63% or so. Mohammed, a big question for a lot of people is, what on earth is defense in this environment? And do bonds start to work, given what we've been talking about all morning?
Well, they've been working the last 2 to 3 days. So, you know, that's the good news, is that you have got some diversification because you've got flight to safety. So they finally have been working, but that is dependent on inflation coming down. If inflation remains a problem, if it proves to be really sticky, then the correlation that everybody wants for risk mitigation will unfortunately dissipate.
That risk mitigation story, Rick, for you, does that return in treasuries?
So, I mean, I always find the best way to manage risk is reduce your risk. I mean, full stop. You know, take basis risk and figure out, like Mohammed said, you've got inflation accelerating, you've got a Fed that's moving. Yes, we have some duration in the portfolio. We think that makes sense. You know, where on the curve you hold that, I think is going to be important going forward. But listen, I always think the first stop. I always think about what hedges can you use, how expensive is it? You know, quite frankly, the cost of the rate hedge got more expensive with rates dropping. The cost of the volatility hedge became in the equity markets became more expensive. So, you know, a lot of what I think about today is let's just reduce the corpus and then manage it more efficiently. Yes, you got to hold some interest rate exposure, but I don't think you should overdo it. And by the way, it doesn't mean all the U.S. as well. There's some interesting things in Europe where, you know, you look at core goods inflation in Europe relative to the U.S., that hasn't come down yet. You could see that coming down. European duration is a way to hold it as well.
We've got about 3 or 4 minutes left together, so let's work through the next couple of days into next week and maybe into March 22nd as well. Mohammed, what would you look for through today's session as all of this news starts to pour through?
So I would look as to what dominates at the end of the day. I will also look as to whether investors recognize what Rick just said, which is that will be opportunities. 3 in particular. One is this is a very good environment for being selective. Secondly, balance sheet and collateral matter. And third, we will see overshoots. We will see good names getting short-term contagion. Like big banks, John, that have been negatively affected actually are going to benefit from what's going on. Guess where the deposits are going to go? They're going to go to the big banks. So it's important not just to worry, it's important also to recognize that there's important investment insights for the next few days.
I guess to some extent, important to have a plan going into the next few days as well, Rick. With hindsight, the benefit of hindsight, the entry point always looks obvious. I'm looking at high yield spreads wider over the last couple of days. We were neatly inside of 400 basis points, in and around 390 earlier this week. We're back to 417 again. When does that start to get a little bit more interesting for you, Rick?
I mean, I don't think we're there yet. I mean, there are, the compression of high yield to quality assets, particularly some of the assets in Europe, when you swap them back to dollars, the compression is too narrow today. I still think you need significantly more for that to be interesting. And I just think quality assets make a lot more sense. And if you believe the Fed's got to go further, you slow the economy down. I think quality assets will hold in a lot better. So I don't think we're there yet. I think the point Mohammed made is really, for as an investor, the most exciting thing that happens when you have a situation like this, the market paints things with a very broad brush. And when you think about, what is the crux of the issue? It's an asset-liability mismatch. Where are the places where your liabilities are durable that the markets have just priced those down? And so much of what we've been doing this morning is going through some of those financial institutions, banks and others, where you feel really good about it's not a liability dynamic and your assets are reasonably well protected.
Rick, I imagine you can't name those institutions, but can you describe those opportunities with a little bit more detail?
They usually move away from me when we do that. So, listen, I think some of the some interesting places in credit cards. I'll stop there. I think we're doing a bunch of work, and I usually hurt myself by talking more freely about it.
Well, I'll keep you out of trouble. I'll follow up on this one. You said you're not interested yet in high yield spreads at 420. The obvious response from me is, when are you interested? Another 100 basis points wider, 200? What's the level you've got in mind?
So yeah, I think it's dependent on where everything else moves. If it goes out 100 and investment grade goes out 75, still not there yet. But I mean, if you got back 100, 150, listen, I'm not worried about a big default cycle in credit. Companies have done a really good job at terming their debt out. Yep. The free cash flow is good, top line revenue. So I'm not that worried. I actually like it better that we talked about in Europe than I do the U.S. You're getting paid for it.
I've got some good news for you. We're out of time, Rick. So the pressure's off. Rick Reeder, that was great. So Mohammed, thank you. The two of you together, just absolutely fantastic, and what a morning for it. Thank you, guys. Coming up, more on SVB and a concerns grip in markets. Plus, we'll break down that payrolls report for you with Tiffany Wilding and Mike Collins.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg.
The last couple of days have been absolutely ridiculous. This morning, a good morning to you. Futures are negative 0.2% on the S&P. Chairman Powell reintroduced the risk of moving to a 50 basis point hike. We started to price some of that in. We've taken it all back. We're pricing in 25. How much of that is about the economic data from about an hour ago, and how much of it is about the risk aversion associated with select financial institutions in the past day? We'll have that conversation through the rest of today on Bloomberg TV and radio. There's your opening bow. Switch to the board and get to the bond market. Yields look a little something like this. Look at this. We're down 15 basis points on a 10-year, 375.63. The move on a 2-year, humongous over the last couple of days, from 5.08% all the way back down to 4.68. That is a 40 basis point move in 2 days. Down 20 basis points yesterday, down another 20 basis points this morning. Looking at the FX market, dollar weakness, euro dollar 106.50. We are positive there by 0.6%, and crude negative by about 0.1%. No drama, 75.65. The broader equity market down just 0.2% on the S&P 500. On the Nasdaq, down 0.2 also, about 45 seconds into the session. Plenty of reaction to the jobs report from an hour ago. This came from B of A just a moment ago. We think it's a close call. We retain our forecast for a 25 basis point rate hike in March. Of course, that's highly dependent still on what we get on CPI next week, March 14th. It's in the diary, I know. Then on to March 22nd for that Fed decision. One stock to watch for all of you. It's SVB. Shares sinking for a second consecutive session before being halted. The CEO, Greg Becker, urged clients to, quote, stay calm during a call with customers. And Katie Lyons, things have been anything but.
Yeah, definitely not calm. Of course, we are still awaiting that pending news, John, but we did have the reports earlier this morning from CNBC that a capital raise has failed and the bank is in talks for a sale. And I was just checking in with a source close to banking regulators here in Washington who also said it seems fundraising talks have been a massive failure. Hence why you are seeing so much pressure this morning. Of course, the stock hasn't traded for some time now, given that halt, but at $39.40 at the last trade, this was a $267 stock on Wednesday. That is how quickly this has snowballed into what seems like a massive bank run. And of course, the concern now this morning, John, is does this bleed beyond just Silicon Valley Bank, which, yes, was heavily exposed to higher risk clients, VCs, tech startups, or is this a signal of something more systemic, especially among regional banks that are less diversified and very exposed to an environment in which the Fed has aggressively raised rates and that bond portfolio has gone down significantly in value, John?
Katie Lyons, thank you very much for that. Plenty of research coming through from the South Side. Morgan Stanley's Betsy Graysick said this, weighing in on the contagion risk for SVB. We want to be very clear. We do not believe there is a liquidity crunch facing the banking industry. The headwind for the banking industry is that the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue, and EPS. She went on to write, we do not expect that other banks in our coverage will need to raise capital. That is because we do not expect the same level of deposit outflows at other banks in our coverage. SVB is, of course, still halted pending news. The turmoil, though, pretty clear, spreading to the KBW Banks Index. That index is on course for its worst week since March 2020. Abby, it's been tough.
It has been very tough, ugly in fact, John. And right now we have the regional banking ETF, the KRE, down more than 15% this week, similar to that KBW Bank Index, headed to its worst week since March of 2020 on what is really a flight on capital. And it's interesting because depending on who you talk to, it really seems to bring different views to light. Now, the idea that this is idiosyncratic to SVB, most likely not. It also has to do with the regional banks because, of course, when they were rich on deposits, investing them in securities, and now that you have clients taking out deposits, forced to sell those securities at a discount, and therefore the reason for the capital raise, that is not specific to just SVB. That will go to these other banks, and therefore you have First Republic down 31% today, PacWest also down sharply. But one reason that the big banks today are stabilizing to some degree, John, is they were forced to do this last year through regulatory capital. So this, what we're seeing now for these regional banks, where it was simply they're forced to market when it actually the loss is taken, it was done in advance for the big banks. So the big banks to some degree are a little bit more insulated. Nonetheless, you have all of these banking indexes down sharply, down more than 10% on the week, headed again to the worst week since March of 2020.
It's difficult to know what to do with this, isn't it? And Abby, thank you. About 4 minutes in, we're negative a third of 1% on the S&P. On the Nasdaq, we're down 0.4%. It looks like any other day until you look at the bond market. And the 2-year yield's down 20 basis points. On top of the 20 basis point move we saw yesterday with a 2-year at 466 and a 10-year at 375, we're down 15 there. 2 days ago, north of 5% on a 2-year. Now the 2-year close to 450. Closer to 450 than 5%. Figure that one out. PIMCO's Tiffany Wilding has got to figure that one out, alongside PGIM's Mike Collins. Deep breath, everyone. Tiffany, let's start with you. You have now an hour or so, 60 minutes to go through that payrolls report. Your thoughts, please.
Well, I do think that the banking sector stress is front and center here, and I think it's a good reason because the payroll report is frankly lagging. I mean, that basically tells us what happened last month, and we always know that the labor markets do lag broader fundamentals in the economy. You know, so I think from the Fed's perspective, really the question here is how tight financial conditions are getting as a result of this risk aversion, you know, stemming from the Silicon Valley bank stress. You know, I think the other issue here, obviously, is that even though, you know, I think the liquidity, you know, a potential liquidity crisis in the banking sector is, I still think the probability is that is low. It probably does cause some risk aversion, you know, with bank managers. I mean, are they going to start pulling back on the margin on credit, you know, start tightening credit conditions a bit more, you know, and that's basically doing heavy lifting for the Federal Reserve. So that just means the Fed doesn't have to do as much. So I kind of agree with the markets here in terms of, you know, taking out the probability of 50 basis points.
So Tiffany, we're saying that before we get CPI on the 14th. Are you saying that the bar for CPI to deliver or at least open the door to 50, case closed, is that really, really high?
Well, you know, I mean, obviously, you know, the stress, you know, some of the stresses that we're seeing in markets right now, it's a question of how persistent are they? You know, if we're coming into next week and you know, if people feel more confident this is an isolated case, you don't get the risk aversion, financial conditions aren't tightening as much, you know, then certainly the CPI report, I think, will take more significance. You know, but our own expectation for this report, you know, is that you know, it's kind of core CPI is going to be kind of where it was last month, you know, and we actually do see some reacceleration potential, you know, over the next couple of months as you have used car prices, you know, that look like they're rising again, which has been kind of an idiosyncratic issue in the United States. You know, so I think it's the bottom line is it's a tough job for the Fed right now. You know, I think, you know, they kind of set out a plan for going 25 basis points to kind of weigh the different risks. You know, they don't want to tighten too much, but they don't want to tighten too little. That still seems like a reasonable plan for me.
Mike Collins, your thoughts on this one, please.
Yeah, Jonathan, a few big takeaways, I think, from the number today, then on the broader market conditions and the Fed. What we're seeing in the numbers today, and we've had some time to dive into it a little bit, you are continuing to see deceleration in almost every metric, from total payroll employment to hours worked, which are down 1.5% from the peak a few months ago, which is a lot on a big economy. You're seeing wages decelerate. Yeah, you have that mix shift, but we've actually looked at the leisure hospitality wages. They were running, Jonathan, on a 6-month rolling annualized basis, around 15%. A year and a half ago, they're down to about 5 now. So steady deceleration. Now, they're not at 3 where they were before the pandemic, And our guess would be that they probably don't get back to 3, that these wages, especially in the leisure, hospitality, services sector, where there's a massive shortage of jobs, continue to be sticky, but generally deceleration there, right? And the Fed, I mean, their MO has always been, they keep moving, especially in an inflationary environment, Jonathan, they keep moving until something breaks, right? And they're so focused on this risk management policy, and there's 2 tails to the risk, right? One is inflation gets too high and they miss controlling it, and the other is something breaks, right? And I would argue the risk of something breaking is now tilting to be a little bit higher than the risk of runaway inflation.
Well, let's pick up on that because that's a really important point, Mike. So, Tiffany, there's 3 parts to this story around the Fed. It's pace, its ultimate destination, and its time spent at destination. Now, if you believe the Fed is destined to break something, can you draw conclusions about how long you think they'll spend at peak?
Well, I mean, I think if we, I don't think the Fed is destined to break something. At least I don't think that's what they want to do, right? They are trying to manage both of those risks, the risk of overdoing it versus underdoing it. And I think they're trying as best they can. But obviously things can happen in a very nonlinear way. When we look historically at payrolls, for example, how they behave after reaching their peak in a cycle, what you tend to see is that payrolls sort of decelerate kind of, nicely, if you will, and that's kind of what we've seen in this cycle. But then eventually they really start to deteriorate, and that's obviously when we go into recession. They don't sort of decline in a nonlinear way and then start to contract. They really just at some point ahead of recessions just plummet. And so it's understanding kind of when exactly that happens, and it's very difficult. So I do think the Fed's trying to manage that risk. The issue here is obviously that we still have very elevated inflation. Now if we do go into a recession, obviously inflationary, the inflation will likely come down, wage inflation will come down. So again, I think it's the Fed trying to manage these risks, just with the issue that, things can deteriorate in a very nonlinear way.
Look at this move at the front end of the curve. Mike Collins, we're down 28 basis points on a 2-year. That's 460, sub 460, 459. We were looking at 5.08 just 2 days ago. Mike, I was speaking to Rick about 20 minutes ago. I'm not sure how much of that conversation you caught. Rick Reeder at BlackRock, but he was talking about maybe de-risking a little bit, increasing the cash allocation again. Are you doing the same thing?
Yeah, I did listen to that interview, Jonathan. Thank you. And always like to listen to Rick and Mohammed's viewpoints. But yeah, we have actually come into this environment in a really de-risk manner in our portfolios. And we have really cut the amount of credit risk we're taking, partly to Rick's point. You're just not getting paid enough to really go deep into the capital structures. I mean, the more levered the companies, the more sensitive they are to higher rates and margin compression. And you're really seeing that start to bite increasingly across the corporate and real estate universes. So stay up in quality. There's a lot of excess yield and spread to be had up in quality. You're not getting paid enough to be down in quality. So that's step one. Keep the dry powder, wait for opportunities to add risk. And I think you're seeing that start to play out here. It's actually been remarkable how resilient, right, the economy's been, how resilient the credit markets have been. I think it's really a testament to the private sector. I mean, throughout this whole pandemic and even today with higher rates, the private sector has adapted, meaning companies and people and businesses have adapted really well, right, to all these conditions. And when rates go up a lot, they kind of de-lever, right? And they look at their balance sheet more closely. They focus on debt reduction, and that's actually a tailwind for credit. So yeah, there's a lot of good credit opportunities out there, but generally you don't want to have a lot of risky credit bait in your portfolio.
Mike, as you know, one man's resiliency is another man's complacency. And some people have said that high yield particularly is looking complacent. South of 400 basis points on a spread, we're now north of that level of 417. When someone tells me I'm not getting paid enough, Mike, I want to know what is enough? How much wider those spreads need to go before you get interested again?
Yeah, so let me put it in yield context just for simplicity, right? So we have a lot of portfolios we manage that are pretty high quality. Some have a duration of 2, some have a duration of 6, and some of these are yielding, in the 6s, close to 7%. Now the high yield market is yielding, in the 8s. So yeah, it looks like it's providing a little bit more, but remember, and we always advise this to our clients, when you buy high yield bonds at 8, you don't keep all of that 8, right? You do lose some of it to defaults. The default rate in the high yield market is at like 1 or 2 right now. It is going to go up to probably 3 or 4. Let's just say it goes to 4, which is about the historical average. That means you lose about half of that to defaults. You get half of that back in the recovery story when you go in front of the bankruptcy judge. So you lose 200 basis points annualized if that default rate averages 4. So that 8-handle yield turns into a 6-handle return, right? Which is very commensurate or comparable to what you're seeing in high quality parts of the market. And to talk about in spread terms, you have 400, we're back to 420 on the high yield market. I mean, I think they have to be 100 wider. And I think we would be pretty aggressive buyers at those levels because, again, the fundamental quality of the companies in that market are actually pretty good right now.
Well, Mike, let's talk about some spread widening right now. When was the last time you saw a headline like this? SVB 2033 bond spread widens to 1,061 basis points. When did you last see that?
You know, Jonathan, you see it when the Fed hikes policy, tightens policy too much, right? And you see the cracks start to come, and you never know where it's going to be. I mean, I wouldn't have guessed it's the Silicon Valley Bank, and it's always that thing you don't guess is going to be the crack and the problem. And you know, you have this run on the bank risk out there, and there's so much debt out there in the world that investors own, from insurance companies to pension plans to banks to investors, that are underwater, right? That they have unrealized losses, right? And if you have to crystallize that, as is happening at Silicon Valley Bank, it gets to be really painful, right? The Fed has a lot of unrealized losses on their balance sheet, right? And I know Powell was being hammered on that in his testimony this week. I mean, so you do have to be careful about pushing too hard on rates and on tightening policy when you do have these underlying fragilities.
Mike Collins, perfect morning to catch up with you. Tiffany Wilding at PIMCO, just absolutely brilliant as well. To the both of you, thank you for working through some of these big issues. I can tell you, we had this massive move in the bond market, didn't see the corresponding move in the equity market until now, the last 5 minutes or so. We're down about 0.8 on the S&P. On the Nasdaq, we're down more than 1 full percentage point, and we have just got a monster move at the front end of the curve on both sides of the Atlantic. 2-year in America down 25 basis points, 462. Over in Germany, we're down 26 basis points. We've just broke 3%, 299. Kaylee Lyle's back with us for more. Hi, Kaylee.
Yeah, John, talking about the corporate credit market, you just said it. You are seeing serious distress now in SVB bonds. That 2033 bond spread now widening to 1,061 basis points. This feels quite chaotic. And of course, we can't look at the corresponding share move because indeed those shares are still halted in pre-market trading, pending news, which we are still awaiting. But at the last trade, it was down more than 60% in pre-market after a 60% decline yesterday. And of course, we've gotten reporting from other outlets this morning about failure in talks to raise capital. We now understand from CNBC that Silicon Valley Bank's deposit outflows are outpacing the sales process. This is the concern around a bank run here, John, that clients, including those that are with certain venture capital firms like the Founders Fund, are being encouraged to take their money out. And Silicon Valley Bank needs to come up with that liquidity. And of course, this is where it comes back down to those book losses realized now as they look at those treasuries that have gone down in value that they now have to sell at a loss. This is a bank that clearly is in serious financial stress, and some of that stress looks like it's bleeding, at least from a share price perspective, to other areas of the banking sector this morning, John.
Kelly Lyles, stay close. We'll come back to you a little bit later in the program, hopefully. So we are about 16 minutes into the session. We're down 0.9 on the S&P. On the Nasdaq, we're down by 1.3%. I'll keep returning back to the bond market. Significant moves here. We're down 24 basis points on a 2-year, 463 on a 2-year yield, 45 basis points south of where we were just a couple of days ago. Just absolutely unreal. AMH down in Washington is going to join us now. Anne-Marie, the Treasury Secretary, has been testifying in the last 45 minutes or so. What are you hearing?
Yeah, John, well, so she's set to really just be talking about inflation and the risks of a recession, but potentially this is going to be something that's going to overshadow these questions that she's facing. What we've heard from the White House so far, from a key economic advisor to the president, Bharat Ramamurthy, is he's saying that the Treasury Department is looking into this. It is quite really too early for them to see what the situation, exactly how this shakes out. They're calling it highly fluid situation, but they didn't want to say exactly what they could do in terms of this regional bank, but that this is something that they are looking into. And what one part was interesting from Mr. Ramamurthy is that he said, I don't want to say more than I can right now, but just to assure viewers it's something we are on top of. that's highly fluid. And what their concern is that if this would spread and to become more systemic. So don't expect any fireworks yet unless this was to become massively spread across the financial industry and the health of financial assets.
Thank you for that. We're just going to work through some of the price action and bring you the latest headlines. A little bit early this morning, of course. Trading halted in SIVP, news pending. That stock was down by more than 60% early this morning in the pre-market, down some 60% in yesterday's session as well. We'll wait for that news. I talked about what was happening in the bond market. The SVB 2033 bond spread widening through 1,000 basis points. That signals, as you all know at home who follows this bond market, that signals real distress. No real signs of distress in the equity market, at least. It's a down day, sure, and it's getting worse. We're down about 1% on the S&P. On the Nasdaq, we're down 1.1%. The moves you're seeing in the bond market, though, let me frame them for you. They're absolutely phenomenal. So you've got Chairman Powell reintroducing the risk, opening the door to a 50 basis point hike, and that two-year yield breaks 5, goes to 5.1%, just short of 5.08, and then comes all the way back down. Risk aversion yesterday, claims a little bit higher, I know, but the bulk of that move came in the afternoon. Down 20 basis points in yesterday's session, down 20 again today. On Bloomberg TV and radio, I'm pleased to say that joining us now is the US Labour Secretary, Marty Walsh, and he joins us from Washington. Secretary Walsh, what a morning for it. Just amazing moves in this market that we can discuss. Amazing moves on the West Coast with a financial institution. Secretary Walsh, you get to represent the administration this morning. I just wonder what your thoughts on what's been developing in the last 24 hours or so.
Well, certainly on the jobs front, we had a good day, but as you have been reporting for the last, I've heard you for the last 15 minutes, a lot of concern in different areas, and hopefully we can continue to move forward here. I know Secretary Yellen is up at Capitol Hill today testifying. There's lots of concerns about what the future of the stock market is. I know that, but when it comes to jobs, we have a good jobs report and good signs all along.
Are you worried that we're starting to see things break as the Federal Reserve tries to address inflation?
No, because we'll be talking about now, and people have been concerned about it for the last year, really. And when you think about what we're doing here, we're seeing jobs being added, we're seeing participation rate going up, we're seeing opportunities for even further participation rate by making some investments, and certainly we're seeing incremental steps in the inflation coming down. So we need to continue to stay focused on that.
And Secretary Walsh,
sorry, I froze there for a second because somebody behind me is talking, so it kind of got my head.
Don't worry, it's fine. It's the last interview we get to do together because I know you're heading to the exit too, so I'll give you the time.
I'm going to miss you. I'm going to miss you.
I'm going to miss you too, Secretary Walsh. I've got to fit a couple more questions in there if I can. We heard a little bit early this week from the chairman of the Federal Reserve. He took a lot of flack, a lot of heat from some Democratic senators, including Senator Warren, who said that maybe he was pushing this too far. It could lead to people losing their jobs. And he said, would working people be better off if we just walk away from our jobs with inflation of 5%, 6%? Secretary Walsh, how did you feel when you heard that interaction earlier this week? What were you thinking?
Listen, as I said from day one, my focus here is to get as many people back to work as possible and continue to see wages go up, working with business, so business is successful. That's what my focus has been for the last 2 years here at the Department of Labor. That's been the president's focus, and we're going to continue on that path.
I know you're heading to the exit. Your replacement facing a little bit of scrutiny right now. You work closely with her. Secretary Walsh, is it a ringing endorsement from your side? Can you give her some words of support?
Absolutely. We've spent the last couple weeks, Deputy Secretary Sewell and myself, meeting with business, meeting with the U.S. Chamber, meeting with the Business Roundtable, meeting with the independent associations. So we're meeting with all those organizations just to talk about what the plan is here at the Department of Labor. We've been connected at the hip for the last 2 years. We work very closely together. Business, I think, has a very good feel for me as Secretary of Labor, and they'll have the same feel for Julie Su when Julie Su gets nominated.
Secretary Walsh, we've got to leave it there. Thank you for your service, sir, and thank you for these monthly interactions. They've been fun. I've enjoyed them, and hopefully we get to catch up soon in your new role.
All right, thank you.
Thank you, sir. Secretary Labour Walsh there. Marty Walsh of the Labour Secretary, of course. I want to come back to this market. Keen to do so for all of you. 22 minutes into the session, equities down 8 or 9/10% on the S&P, and the bond market just a monster move. We're down about 23 basis points on a 2-year. 464. I want to bring Katie Lyons back into the conversation. Katie, still halted, news pending, but we've got some news, haven't we, in the last 20 minutes?
Yeah, indeed we have. Of course, we've had the headline related to SVB's credit, the 2033 maturity, now seeing it widen by 1,061 basis points. We also have gotten reports, John, from other outlets about the sale process, because we understand that fundraising talks, raising capital for a Silicon Valley Bank has failed. They are now looking at a potential sale, and we also understand that now the withdrawal of deposits is outpacing the sale process. So this is a bank that is certainly in crisis. We are still awaiting confirmation of whatever that pending news may be, but at the time of the share halt pending that news, this was a stock down more than 60% once again today after a 60% decline yesterday. We are now trading south, or we were, of $40 a share. This was a $267 stock on Wednesday. That is how quickly this has unraveled. What is happening here as we are seeing now realized book losses for one of these banks that, of course, was smaller, of course, exposed to higher risk clients in VCs and tech startups, but there are still a lot of pain bleeding through to other banks as well that may have similar exposure, like First Republic, which is having its worst day since the financial crisis era, down by double digits, applying to other regionals as well. There is a lot of concern now about this health of the U.S. financial system, John, in the middle of aggressive Fed rate hikes, and a jobs report today that raises the question of how much further those hikes will go.
Kayleigh, in the last 24 hours, the analyst community has been very clear to draw a very, very bold, thick red line, black line, if you will, between what's happening with companies like SVB and what is not happening with the large banks on Wall Street. There is a clear distinction this morning. With Bank of America, let's pick a bank, they're down only 2.8%. Kayleigh, are you seeing that distinction being drawn when you look at the smaller regional lenders as well?
You aren't seeing quite the same distinction. You definitely are seeing steeper losses for also tech-exposed banks like First Republic than maybe some of the other regional banks, but they are facing far more pressure here than their larger bank peers, John, and it does come down to that diversification. The narrative theory here is that those larger banks are not as heavily exposed so acutely to riskier areas. I mean, we have to consider this also is coming in the week of Silvergate, which was heavily exposed to crypto, also very high-risk clients. Now we're talking about startups that also are facing their own funding and liquidity challenges amid a changing macroeconomic environment. It is about the exposure here that is not as diversified, that is so specific, and it is affecting these banks to a larger degree. But John, yes, you're absolutely right. It does seem, at least on the street, that they are really trying to make it clear that there is a distinction here, that this is not about some broad systemic risk in a financial system. It is just those that are exposed to a greater degree of risk in certain pockets of it.
First Republic getting hammered. That stock is down by some 51%. Kayleigh, thank you for that. The line you've heard, the phrase you've heard from Mike Mayo of Wells Fargo and others too, is a lack of funding diversification. I read this quote out earlier. I'll share it with you again. This is what Mike Mayo's got to say on the situation. He said, SIVB is worst case. The core issue at SIVB is a lack of funding diversification. Most SIVB deposits are from VC, has its issues. To us, the larger the bank, the more diversified the funding. That's the line you're going to hear again and again and again. I've heard it all morning, the whole of yesterday as well. Your broader equity market's recovering just a little bit. We're down about 0.75% on the S&P 500. At the moment on the NASDAQ, we're down a little more than 1 full percentage point. We've had a massive move in the bond market this morning. Had a big one yesterday too. We're down another 22 basis points on a 2-year to 4.65. Want to get you the trading diary just briefly. You will hear from the president a little bit later on, 10:45 Eastern. He'll meet the EU president a little bit later on as well. Pushing ahead to next week, Tuesday. It is the only thing that matters. It's CPI day in America. Then you get some retail sales as well. From New York City, that does it for me. If you can, enjoy the long weekend, or rather the next couple of days. This was the countdown to the open. This is Bloomberg.
think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own To Live and Work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave. Want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidodi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future,
connection lost.
She hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools.
Wow, well
So our intention has been to give all 360 degrees, type of opportunities to the students so that, whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the Garden City feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planted terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city